Equity trading. I'm Tom McKenzie in London, and here are your headlines. Energy impasse, EU efforts to strike deals on price caps for gas and Russian crude stall as divisions push approval of some measures into mid-December. Oil trades little changed. COVID alarm, China's daily case count tops 30,000 for the first time, with parts of Beijing seeing panic buying as officials struggle to contain outbreaks across the nation. And Black Friday gloom. Retailers brace for muted shopping results while thousands of Amazon warehouse workers across 40 countries plan protests over pay and working conditions. Let's take a look at the futures then after, of course, the Thanksgiving holiday in the US. US markets, equity markets will reopen today for a shortened period of trading. European markets looking to build on 3 days of gains. They're currently at levels last seen at around mid-August. The big question is to whether or not that, of course, can be sustained. Currently, the FTSE 100 is range-bound. We'll look for the other indexes. We had German GDP data quarter-on-quarter coming in slightly better than estimated. That following on from the IFO survey earlier in the week. The PMI data as well coming in out of Germany, slightly less bad than expected, suggesting that maybe if that economy does head into recession, as many expect, it may be slightly shallower. That is a view of some economists out there. Over in France, the CAC currently just very modest gains of 3 points in the first few seconds. The Spanish IBEX also range-bound. We're looking at Iberdrola as one Spanish company in the mix there around some deal-making. We'll bring you the details on that in the next few minutes. Let's check in cross-asset then again as the US looks to reopen at least partial trading post-Thanksgiving. Treasuries are already trading, and there's a move in across the board on yields down across the Treasury curve. In terms of futures then, looking to build on the gains that we closed out on in the middle of the week. Gains of 0.2%. The US 2-year 444, that's a move lower by 3 basis points. As I said, bid across the curve. The pound holding on to gains 120, a little bit of pressure. It's down 0.2%, but you saw that rally more than 0.5% in terms of the gains for sterling yesterday. You had the Deputy Governor of the BOE coming out saying there is more work to be done to raise rates and tackle inflation in this economy. Brent, $85 a barrel. That's getting 0.4%. The context is you're still on course for a third week now of losses for oil. We continue to watch, of course, the discontinuity, or at least the breakdown in terms of the conversations in Brussels about how far to go with that price cap. Let's have a look at what's happening in China then. I've just been having a conversation with people on the ground in Beijing, really illustrating just how much anger there is now in the capital. That was the view, at least, of some of my contacts on the ground. The conditions in those central quarantine areas that people are being shipped off to, yes, large parts of the capital, the world's second largest economy, are now essentially locked down. The CSI 300, the benchmark, though, despite that, posting gains of 0.5%. That will be largely linked to expectations of additional support. We are waiting for potentially a triple R cut for the banking sector. Over in Hong Kong, the Hang Seng currently trading at 17,569. That's just a modest loss to 0.5%. But this pressure is really being felt in the tech sector once again. So much volatility in this index, with HS Tech currently trading at 3,500. That's a drop of 2.3%. Again, tying to that COVID story. Record caseloads in China now. Right, let's get over to Anika Gupta, Research Director at WisdomTree, for analysis and a take on what is happening in these markets. Anika, I was talking about the fact that European stocks are currently at levels we last saw, I think, August the 17th on my last check. Do you buy this rally? Are you convinced that some of the headwinds are starting to dissipate now for European equities?
Morning, Tom. Well, equities have, European equities in particular, over the last few weeks have had quite a strong run. They're actually outperforming the US. I wouldn't buy into that rally yet, but a few factors have been improving on the economic side. We've seen, as you mentioned at the open, we've seen the Zeus survey, expectation survey actually point to the upside. So we're looking at the European economy moving into a recession, but that rebound from that recession should be a lot quicker than we previously anticipated. We've even seen the IFO data again. Current conditions are declining, but the expectations going forward have actually risen, and we've seen the same in the PMI data. So they're all pointing in the same direction. Europe is facing a much harsher winter, but looking ahead, that duration of the recession appears to be a lot shorter. So I wouldn't buy into that rally right now. I would be very selective on where I'm looking at within the European equity space. But definitely on the positive front, there's a lot more to look forward to within the European equity space.
Okay, that's really interesting. What kind of timeline are you looking at, Anika? And if you're remaining conservative and selective, how defensive do you want to be? Are you in healthcare? Are you in, for example, utilities, energy? Is that where you want to be hiding out until you see convincing evidence that the recession risks are starting to fade?
Absolutely. So we've already heard, from Isabel Schnabel just yesterday, comments coming in from her saying that we're not really ready to move away from restrictive policy, which clearly states that as far as Europe is concerned, we have already entered a recession, and at the same time we will have the ECB tightening into a recessionary environment. So that clearly is a headwind. So within Europe, I would stick to the more defensive sectors, as you mentioned, like healthcare. I would also expect financials to do better in this current environment, given we are going to see rising rates, despite the fact that the Fed, the minutes that we've seen from the Fed meeting are now gradually pointing in the dovish direction.
Okay, interesting. Still some way to go then, maybe in terms of financials. I know you have deep views on, or at least you spend a lot of time looking at the energy sector. And of course, we're focused on what's happening in terms of the negotiations in Brussels. Oil then set for a third week of losses. We touched on Brent just a few seconds ago, currently trading at around $86 a barrel. So a little gain in the session today, up 0.8%. But longer term, as you look out to 2023, Anika, do you see these sustained pressures on Brent and on oil continuing, or is there some uplift from a reopened China next year?
We're definitely looking for the supply-demand balance to move into a tighter territory, moving into the second half of 2023. And I think investors right now appear to be stuck in this mindset of, yes, the economy is moving into recession, and hence, given the news headlines we're getting out of China, which seem to appear more bearish, given the fact that we're continuing to see these lockdowns in place, investors just see that demand coming from China just waning. But at some point we will start to see China reopening. We will get to the summer period, and at that point in time, I think that renewed demand coming in from the Asian economy, alongside some key catalysts, such as, just this month, we're going to have two very important events with, the OPEC meeting on December 4th, followed by the EU embargo on Russian oil. We've seen the critical decision by EU energy ministers yesterday being delayed slightly, on how they're likely to impose the oil price cap. But at the end of the day, these factors are more bearish than anything, because as we all know, the Russian deputy minister has said very clearly, we will not sell to those countries that do, follow on and do impose that price cap on oil. So if anything, that would be a more bearish indicator. And let's not forget, we've also going to have the US SPR reserves, come to an end, which will again be another tailwind for oil prices. So I think looking forward, the trajectory for oil prices will be headed higher. This short-term pain that we're seeing is really a reflection of, downward demand constraints.
Okay, so relatively short-term in terms of the pressure, or at least the pain across oil. When it comes to the treasury markets, or at least fixed income, Anika, we have this line from JP Morgan, the expectation that maybe the demand-supply dynamics will shift in 2023, and they see about $1 trillion worth of demand coming through, which will support bonds and pressure yields. Does that align with your view? Is that something that could be of interest as well as you look to next year?
Yes, that I would agree with that view. We are likely to see yields come under pressure. We're looking at, the Fed continuing to, we're looking at a lot more clarity in terms of the path of Fed rate hikes moving into the first quarter of 2023. And that clearly does point in the direction of further pressure on yields. And from that angle, we've seen most of 2022, seeing this very tightening environment actually pressurize the equity space. And I think come 2023, we will start to see a bit of that pressure being released in the form of yields, and that should, provide some sort of relief within the equity space.
Where would that relief be most pronounced? Would technology get some headwinds with that kind of dynamic at play next year? Yields start to come off, or would it be too early to look back at a sector that, of course, is within firmly the growth basket, but firmly hit by these valuation squeezes?
I think investors are slowly realizing, that the boom that we saw during the COVID period that helped and was a very important tailwind for the technology sector is gradually coming off. We've seen that in the earnings results. We're not seeing those stellar earnings reports and there's continuous beats that we were so used to over the COVID period coming in from the technology sector. And hence investors are now readjusting their earnings expectation within the technology sector. So I think that immediate pressure of these longer duration tech sector will start to get some relief. But at the end of the day, I think investors are going to be very selective within tech as to where they're actually investing. I don't think it's such an easy bet as just looking at the tech sector. I think investors are going to be scrutinizing, the winners versus the losers within the technology sector, and we've seen a lot of that take place over this past year.
Yeah, can't just buy the basket, can't just buy the index. The need for scrutiny when it comes to that sector and selectivity now across equities. That is a call from Anika Gupta. Really fantastic insights. Thank you for joining us this Friday. Hope you have a wonderful weekend. Research Director at Wisdom Tree. Now, coming up, the EU remains split, as we discussed, over how to tackle the energy crisis, with plans to cap gas prices and Russian oil exports put on hold, pushback, kicked into the long grass. We're going to have all the details next. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues. We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest the cleanest and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open Happy Friday, 13 minutes into European trading day. Range bound across European equities. Futures in the US pointing up to around 0.2%, 0.3% on the NASDAQ futures as the US looks to reopen, at least partially, for a partial day of trading after the Thanksgiving holiday. Let's get back to what's happening in Brussels, though, on the ground. The EU has paused efforts to approve an energy package that would cap the price of European gas and limit Russian oil exports. Deep divisions, very deep divisions remain over the plan to address the energy crisis. Spain has been a harsh critic, although its energy minister remains optimistic that a deal can be reached.
There was something that was missing, this very important signal to the markets and traders. Of course, we need gas, but we cannot be sold at any price. So it was important to provide some inputs on how we can send this signal to the traders. And for the time being, the proposal of the Commission was not sufficiently effective. I would like to see this dynamic solution.
Okay, for more on this, let's bring in Bloomberg's Maria Tadeo, who is at the EU Council building in Brussels, and of course, we're speaking to the Spanish minister there. Maria, all about the price caps yesterday. We still have no agreement. The Spanish are relatively optimistic looking forward, though, but no agreement on either the cap for European gas prices, which you detailed for us the complexity of that yesterday, or indeed a cap on Russian oil exports. So what happened?
Well, Tom, I think what happened is we were here for 12 hours yesterday and we went home the same way we started the morning, empty-handed. There's no price cap either way. And again, you make a very good point, and we should always clarify and distinguish. There's two caps that are being debated as we speak. You have the gas cap. Of course, the point, the issue, the sticking point there is the threshold, the 275 euros megawatt hour for 2 weeks in order for that cap to be activated. Those that want it say the facto, the Commission has come up with a proposal that does not work, and this is not a price cap. They want to see that price change. And then the flip side of this, you have the Russian oil cap. The issue, well, very similar, is the price point. We're talking about a range of $65 a barrel to 70. Some of the more hawkish countries on Russia, including the Poles and the Baltics, say that at $65 a barrel, you're still too generous in Russia. That is not going to make a difference to Vladimir Putin, and therefore the price needs to be lower. Now, where do we go from here? On the gas, we have a date, December 13th. That's when energy ministers will meet again, hoping now to get a deal. When it comes to the oil talks today, they continue now. We've been here for 3 days. We're being told potentially could come today, but again, I wouldn't hold my breath.
Okay, mark the diaries then, mark the calendars. Maria Tadeo will be on the ground mid-December, for the gas conversation. Meanwhile, energy also at the center of growing tensions between Brussels and Washington, D.C. What is the issue there, Maria?
Well, Tom, is fascinating, and if you think about it, the two are extremely connected. On the one hand, you have the energy crisis, you have China with a very aggressive industrial policy, and now the Biden administration with the Inflation Reduction Act, which of course would provide subsidies for the green industry. For the Europeans now, they feel and worry that ultimately the space they have to stay attractive and competitive, it's becoming smaller and smaller. I spoke to the Czech industry minister. Remember, they hold the rotating presidency of the European Union. He says pretty much every member state of the EU has concerns about the Inflation Reduction Act. That will be the major talking point. But again, it goes back to what is really the anxiety here, is the concerns that this war could essentially lead to a long-term decline of the European industry. Of course, they say they want to avoid that.
Yeah, really interesting. We spoke to the CEO of Enel yesterday, and they were explaining how they're pushing into the US market and the transparency, or at least the clarity that they now have from that Inflation Reduction Act. Of course, the implications for Europe are pretty significant of that. Bloomberg's Maria today, of course, on the ground in Brussels with all the context around gas and oil. Let's turn to China now. Supermarket delivery apps in Beijing are being overwhelmed as the city's rising COVID caseload triggers lockdown-like restrictions, they don't want to call it that, in some areas. Joining us now is Bloomberg's coverage lead on consumer health and media in Asia, Rachel Chang, who, by the way, for the context, has been covering this really from the outset of the pandemic. Rachel, I've been messaging people on the ground in Beijing, even people committed to that city and to that country are pretty desperate now, sending me photos of kind of quarantine and what it looks like. And the lack of food in some areas of Beijing. What is the situation as you assess it on the ground in that capital?
Yeah, that's right. I mean, we're really seeing the capital hunker down. You know, we're seeing people, stay home. In some cases, they're being forbidden to go out. In other cases, they're afraid to go out, really, because they don't want to scan any QR codes and get pinged for being a close contact or being in a high-risk area and then being thrown into these terrible quarantine camps where we know the conditions are really, really not suitable for most people. And the situation in Beijing, really, 1,800 cases today, a record. That number seems so small compared to what the rest of the world has gone through for the last 3 years. But for China, it's very much a situation where the virus is closer than it's ever been before for most people in China and in Beijing. So this is really, really a test for China's tolerance of how far it's going to go at this point with allowing that virus to spread.
Yeah, I remember when I was there, Rachel, I never met anyone who knew anyone who had COVID. We'd look on the app, you'd see maybe 3 cases in Beijing, a city of what, 26 million? And you wouldn't feel too concerned. How was all of this impacting China's COVID strategy?
Right, exactly. And, that's really the question that people have for China right now, right? What is the exit plan? What is next? We saw a couple of weeks ago that China did come out with a new directive to say, look, we've got to pull back on these measures. They have to be more targeted, more refined. We need to be careful of the economy. But as that virus is spreading so quickly as cold weather comes, and we do know these contagious variants spread so fast if you don't have hard lockdowns, if you don't have mass testing. So it's really, China's trying to walk that middle road between still suppressing the virus, and not disrupting people's lives. And I think we're beginning to find out, especially in Beijing, that that's really not possible.
Yeah, are we looking at a pivot point now for this policy? Rachel Chang, of course, in Hong Kong for us, covering what is happening in China, the mainland as well. Thank you for that assessment and the analysis. Right, coming up, Black Friday in focus. We're going to dig into retail and consumer spending on what, of course, is one of the busiest shopping days of the year. Stay with us. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Welcome back to the Open. We are 23 minutes into the European trading day. You're seeing losses of just 0.1% in Europe after 3 days of gains, and the European benchmark is still at levels last seen around mid-August. Futures in the US pointing to gains of 0.3%. On the S&P, E-mini says they can back from that Thanksgiving holiday, at least for a partial day of trading. Let's get the Bloomberg Business Flash now with Alice Atkins. Alice.
Hi, Tom. The Institute of International Finance says the world economy will be as weak next year as it was in 2009 after the financial crisis. It says global growth is expected to slow to 1.2% in 2023, with the risk of Russia's conflict becoming a, quote, forever war. Elon Musk says Twitter will vastly expand the reinstatement of banned users from next week. That's after more than 70% of participants voted in favor of a general amnesty for suspended accounts in a poll organized by the company's new owner. Meanwhile, Twitter has now lost its final 2 employees in the regulatory hub of Brussels, just as it faces increasing scrutiny from EU lawmakers. 6 people were previously employed in the office. The account of the latest ECB meeting shows some officials wanted a smaller 50 basis point rate hike in October to combat record inflation. Those favouring a less aggressive move pointed to other measures that came with the hike, including adjustments to the terms of cheap financing for banks. However, ECB Executive Board member Isabel Schnabel warned in a speech in London it may be too soon to scale back rate hikes. That's your Bloomberg Business Flash. Tom?
Alice Atkins, thank you very much indeed. We're going to zero in on some of the individual stories, corporate stories that have taken our attention, grabbed our attention as they move about 25 minutes into the European trading session this Friday. Look at the move there for Devro, gains of 60%. This is a company based and listed here in the UK. They make casings for things like sausages. And they've been offered at least a buyout attempt by Saria Nederland. They've agreed to buy this company for a 65% premium. That's why you're seeing a gain there of about 60% for that company. Scottish and Southern Energy, meanwhile, SSE, they've managed to agree to spin off 25% a stake in their transmission operations business for about 1.5 billion, gaining about 0.7% there. And talking of energy, Iberdrola, of course, a Spanish utility giant, energy giant, currently gaining 0.5%. Norges Bank, it apparently has come out as one of 3 final bidders for a stake in Iberdrola and its renewable portfolio, valued about 1.2 billion euros. So Iberdrola making some progress on spinning off some of its renewable assets. Again, they're just 0.5%. We can check in more broadly on these markets there. And again, as the US comes back after the Thanksgiving holiday, you are looking at futures in the US pointing to gains of 0.3%. Investors continue, of course, to think about and consider those FOMC minutes. We heard from the ECB officials split over whether they should go on 50 or 75. They, of course, did go finally to 75. We're looking ahead to the meetings and the decisions in December as well, both from the Fed and the ECB. The Bloomberg Dollar Index currently softer as well, so weakness continuing for the greenback, fueling a very, very modest risk on, at least when it comes to the futures in the US. Plenty more coming up. Stay with us. This is Bloomberg.
These floating flowers are made of 92,000 solar panels. Laid on the surface of a reservoir, they can generate 41 megawatts, which is enough to power 20,000 homes. It's one of the biggest floating solar plants in the world. Floating solar arrays have been gaining traction in Asia, including countries like Singapore and Thailand. Floating projects typically benefit from an easier connection to the power grid. They can also restrict algae blooms while keeping the solar panels cool. This one in particular has helped the local economy. When the power plant was first proposed, residents were given the chance to invest. Some locals were also offered jobs during construction. In fact, it was the community that requested the panels to be shaped as flowers to look more appealing. South Korea still relies heavily on imported fossil fuels, but will need to change that to reach its goal of becoming carbon neutral by 2050. Solar plants like this one may help the country reach its net zero goals.
We're in the early stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
Welcome back to the Open. We are 30 minutes into your European trading day, and here are your top stories. Energy impasse, EU efforts to strike deals on price caps for gas and Russian crude. Well, they stall as divisions push approval of some measures into mid-December. Oil trades little changed. COVID alarm. China's daily case count tops 30,000 for the first time, with parts of Beijing seeing panic buying as officials struggle to contain outbreaks across the nation. And Black Friday gloom. Retailers brace for muted shopping results, while thousands of Amazon warehouse workers across 40 countries plan protests over pay and working conditions. Let's check in on these markets then, talking of lackluster retail sales, lackluster moves within European equities after 3 days of gains. And of course, the context is you've seen a run-up in terms of European stocks since around mid-August, building on those gains. But today, you're just off by 0.1%. Of course, US markets come back for partial trading after Thanksgiving. Futures in the US pointing to gains of around 0.2%. The DAX, as you can see, just off by 7 points. The benchmark off by 0.1%. Here in the UK, the FTSE 100 is up 6 points as well. Across your sectors, utilities, healthcare and telecoms leading the pack, but only by gains of between 0.2 and 0.3%. At the bottom of the list, real estate selling off down 1.6%. The dollar as well coming back just a bit on the back of 3 days of losses, and dollar weakness has been part of the modest enthusiasm you see for equities in terms of risk on. There's a move as well into US Treasuries as well, yields coming off, but other sovereign debt currently selling off. But it is across the curve, US Treasury yields are lower. The 10-year currently trading at 3.66. These are your sectors then. Utilities, as I said, top of the list, just getting 0.2%. You've got stories around Iberdrola and other utility companies as they look at asset sales and spin-offs. At the bottom of the list, real estate under pressure, just down around 1.7% for that sector. Let's get back to what's happening in the retail space then. It is Black Friday. Is your Black Friday bargain actually a leftover from last spring? And what is happening with inventories? Given the extent of excess inventory combined with a shift from pandemic purchases this year, the deals on offer this week comprise current season stock, but also items that have been hanging around since the spring. Joining us is the author of a story on the subject and someone who is always in the weeds on the retail space, Andrea Felstead of Bloomberg Opinion. So, Andrea, how is this holiday season shaping up? How does it compare to previous years?
Well, I don't think it's going to be a total turkey. There's lots of doom and gloom, but there's a couple of things to remember that may see it be a bit better. Lots of consumers are clearly under pressure, but others have still got pretty robust personal balance sheets. Plus, it's the first holiday season for 3 years where the economy's open. Last year we had Omicron, so that will see people visiting friends, going out to pubs and restaurants. So I think it's not going to be as bad as we all expect. After Christmas, whole different story.
We were speaking to an analyst out of the US yesterday. He was saying that in terms of unit sales, they're likely to be down. The dollar figure is going to be up because of pricing pressures, but unit sales down. But he also said the big difference as well is people want to be in physical stores versus buying online. Are you seeing that shift as well?
Yes, definitely. We've seen that all year, that online we all shopped at home in our sweatpants. Now we want to be out and about again, touching the fabric, trying on the makeup. So there's been a big shift back to physical stores.
Yeah, I've been there, dabbling with the makeup, absolutely, Andrew. When it comes to, we talked about Amazon and concerns there amongst their employees, not for the first time with Amazon warehouse workers, but there is now across 40 different countries angst, anxiety, some forms of protest from warehouse workers, Royal Mail workers as well. What is happening in terms of the workers as they look to higher wages in this inflationary environment? How is that likely to impact the service?
That's going to impact because I think this will be a pretty robust Black Friday. So if consumers see sort of news of these strikes and are worried about their orders, they may well hold off from shopping. Now that's a sort of double-edged sword, because if they hold off, they might shop when there aren't bargains. Some people will stop shopping altogether. The trouble is Black Friday tends to kick off a very promotional season. Once you go into discount, you don't go to full price again. So although there might be some effect from people shopping later, there's not going to be much of that. The biggest danger is people see, oh, my order's not going to get to me, I won't shop.
What do we know about inventories? How much of this is about those retailers trying to shift that inventory build-up? How significant is that inventory build-up? How much of that is going to be shifted? Or are they under pressure to maintain their margins? They can't cut too deeply.
At the moment, we've got a bit of a standoff. We've got consumers, many under pressure. They are thinking, I want to shop, but I want to save money. I will buy on discount. You've got the retailers who have had a pretty torrid year after the inventory build-up, who want to sell as much as they can at full price to maximise those margins. It's a question of who's going to blink first.
Okay, Andrea Felsted, thank you very much indeed. Of Bloomberg Opinion, of course, you can read more from Andrea and the Bloomberg Opinion team via OPIN Go on your terminal. She doesn't think it's going to be a complete turkey, today's Black Friday sales. It's not just today, of course, it's a number of days. Okay, let's turn our focus to the Asia Pacific, where UBS and Morgan Stanley, where they are benefiting from Credit Suisse's struggles and woes. Both are seeing inflows as clients fleeing from the embattled Swiss lender, with rival UBS in particular gaining hundreds of new clients. Bloomberg's finance team leader, Tom Metcalf, has the details. Tom, interesting, of course, that this is happening in Asia. How much of a blow is this to Credit Suisse? This is really a gut punch.
Yeah, I mean, it's a fascinating story out of Asia, and I think the big thing really is at the wealth management where they're really struggling. That is meant to be the bit where the bank really survives and kind of goes forward. So yeah, a gut punch I think is the right word, and I think also it's really painful the fact that UBS is the one sort of benefiting from Credit Suisse. Their crosstown rival, their market cap something like 6 times as big now. So yeah, no one's having much fun at Credit Suisse.
Wow, six times as big. How sticky is the shift in money, Tom? These relationships build up over years, client relationships. Is this about a temporary movement of funds from Credit Suisse to UBS for some of these wealthy clients, or is this a longer-term shift?
Yeah, I think that's certainly the message that Credit Suisse are sending. They're basically saying, we're not expecting these fund flows to sort of be permanent, and we're hoping that they will reverse. I mean, they'd obviously say that. I think the challenge is if you're a wealthy client, Credit Suisse is not looking particularly attractive right now. And I think, it's the challenge for them is how can they stem that and obviously at some point reverse it. But if you're a wealth management business, you're probably rubbing your hands at the prospect of maybe more money coming from Credit Suisse way.
Yeah, indeed. And what about shareholders? How are some of the major shareholders in Credit Suisse reacting to this?
Yeah, well, we've seen the shares this week really fall. So I think down 6% on Wednesday, 2% yesterday. So, overall, the shares are down, I think, something like 60% this year. And I think all the eyes, again, are on the next set of quarterly results, right? Come through early next year. What Credit Suisse was saying is these outflows have sort of slowed down since the early weeks of October. And I think that's what people are really going to be focused on. Maybe there'll be some more updates from Credit Suisse in the coming weeks, or more likely Q4 results will sort of be, you know, the latest time for the executives to face the music.
Your memory is still holding up, Tom. Yeah, 61% year to date down for Credit Suisse. Deutsche Bank, very different story, of course. It went through its own restructuring, and now it's back in a big way, it seems, in Asia. What's happening with Deutsche Bank and their footprint there?
Yeah, fascinating to talk about this in contrast, really. You know, Deutsche Bank's executive out there came out and saying, we're expecting to grow our deal-making business. So, you know, I think everyone is struggling in ECM. He wasn't hiding away from that, but he was saying this is where we expect to see some sort of growth in the coming year, so we're going to invest, we're going to put people in. And, you know, that might be a bit of a bright spot in the sort of wider investment banking world. But yeah, no, when I read that story, it was sort of a kind of refreshing change almost from all the doom and gloom we've been hearing about the deal making, the ECM sector.
Yeah, what a contrast with Credit Suisse then versus Deutsche Bank. Bloomberg's Tom Metcalf, thank you, walking us through the fund flows from Credit Suisse to some of its main rivals, of course, UBS, but also Deutsche Bank looking to expand in Asia. Right, coming up, the crypto lender aiming for a $1.5 billion valuation, despite the crisis of confidence across, of course, digital asset markets. We're going to have more on that next. This is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. A multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the Open. We are 42 minutes into the European trading day. You're seeing soft losses, modest losses on the European stocks benchmark, currently down 1/10%, but the futures in the US are pointing up by 0.2%. Euro dollar currently holding above 104. The pound is trading at 121 after the rally of yesterday. Let's get over to what's happening then in terms of crypto. And one of Asia's biggest crypto lenders is targeting $100 million fund, or in funding, $100 million in funding, despite the industry chaos caused, of course, by the collapse of FTX. If successful, the funding round would value Matrixport at $1.5 billion. For more on this, I'm joined by Bloomberg crypto reporter Savashri Ghosh in Singapore. Savashri, what do we know about the discussions on the fundraising? The timing is interesting, to say the least.
Indeed, it is. And firstly, let me just give a quick brief about Matrixport. Matrixport is a crypto lender based out of Singapore. They are backed by investors like DST Global and Tiger Global, and now they are looking to raise $100 million at a valuation of $1.5 billion. We understand that the first $50 million of funding is tied up. They are still looking for another $50 million to be committed from investors. That's the update that we have regarding the deal. However, I want to add that Matrixport has said they have no risk of insolvency from FTX, but there are clients that they have who have exposure to FTX-related products. So that's the summary of Matrixport as a lender, which is looking to raise funds in this stormy market.
Okay, and that detail is important. How likely is it that they're actually going to be able to raise this money? How much appetite is there to lend to this sector? What are we seeing?
A very good question, Tom, because VCs, the venture capital that we are seeing, are pretty reluctant to put in fresh money as we are looking around the world, where crypto markets are the confidence in the crypto market is pretty shaken, right? And we have seen that the overall digital assets market is also pretty low in confidence. It's weak overall. So yes, it will be an uphill task for Matrixport to raise this kind of money at a valuation of more than $1 billion. So yes, it will take time, may be challenging, and we don't know what the eventual fundraising amount will be. It is tough times now to raise funds for anybody in this market.
I'm looking at crypto, Bitcoin right now, down 0.7%, but holding above 16,000. Savashri, what are you and the team looking at and monitoring in the days ahead, more broadly within the crypto sector, as we continue to monitor the fallout of FTX?
Absolutely, and we are all actually, this is a very good question. We are all looking at the contagion effect, because as you rightly mentioned, the Bitcoin market is still steady but weak. We are near the bottom of the market. Nobody knows what kind of more bad news can come out, but yes, we are looking at Genesis, BlockFi, this kind of companies which are not able to raise funds. They are imminent in terms of bankruptcy concerns. So more bad news, more contagion, more concerns from the FTX fallout. These are the concerns that we have and we are looking out for in the weeks ahead.
Okay, Bloomberg's Savashri Ghosh, thank you. Get some rest this weekend after a pretty turbulent few weeks. We appreciate the analysis and the update. Let's get the Bloomberg First Word News now with Alice Atkins. Alice.
Hi, Tom. Rising COVID cases are triggering lockdown-like restrictions across many parts of Beijing. China's capital saw more than 1,800 new infections yesterday, up from fewer than 100 a fortnight ago. Schools and entertainment venues are closed, with grocery delivery services reported to be struggling with demand. Ukraine says it's managed to restore about half of its power capacity knocked out by attacks from Russia, with water supply also back in Kyiv. In the US, President Biden said he's confident there will be support in the newly elected Congress for additional aid to Ukraine. This as President Putin's war reaches the 9-month mark. Nurses in the UK are to strike on 2 days next month in a historic walkout over pay. The Royal College of Nursing is demanding a 17% increase, which the government says is not affordable. It's the first ever national strike by nurses. Malaysia's new Prime Minister, Anwar Ibrahim, will test lawmakers' support for his leadership with a confidence vote on December the 19th to prove he commands a parliamentary majority. Anwar was sworn in by the Malaysian king on Thursday night, cobbling together a unity government with the Barisan Nasional coalition. The monarch intervened after no alliance secured a majority in the election last weekend. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom?
Alice Atkins here in London, thank you. Coming up, a subdued tone in markets after a Thanksgiving holiday in the US. We're going to discuss what is moving equities, fixed income and FX. That is up next. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Daybreak with links.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Count Under the Close.
Welcome to Bloomberg Crypto.
Welcome back to the Open. Happy Friday, 51 minutes into your European trading day. You're seeing losses of 0.2% on the European benchmark. Futures still holding up stateside, looking to build on the gains of midweek of around 0.2%. After that Thanksgiving holiday, coming back, of course, for partial trading. In treasuries, you do have money moving in across the curve. Yields down on the 2s and 10s. 10's currently 367. Just checking in the Bloomberg Dollar Index because it's so important when it comes to that risk on or risk off sentiment. Currently range bound after 3 days of weakness for the US dollar. Let's take a look at some of the things to watch out for today then. At 9 a.m. UK time, we're going to have consumer confidence readings from Italy as we continue to kind of build out the picture in terms of the economic resilience or lack thereof in Europe. Then at 12 p.m. we're going to get data from Mexico, including GDP and the current account balance. An important look at an EM there, of course. And quickly followed at 12:30 p.m. by Brazil with federal debt data. It is, of course, Black Friday, which kicks off the holiday shopping season in the US and elsewhere. Bloomberg Intelligence says retailers like Walmart, Target and Costco appear positioned for a solid period, aided by a flight to value. Global stocks, meanwhile, and currencies are pretty mixed amid a subdued tone in markets today. Treasuries climbed as trading resumed after Thanksgiving holiday in the US. Asian markets near the end of the trade mixed as China's daily case count tops 30,000 for the first time. And really importantly, you're seeing essentially a lockdown. They haven't called it that, but that's essentially what's happening in the capital, Beijing, and that would be for the first time. Let's bring in Bloomberg's Joe Easton for all these market lines. And Joe, just give us the context. As we look at the gains that continue to be built, okay, we're seeing modest losses across European equities. The context is they've rallied since around mid-August. And then we look ahead to additional data out next week. What are the catalysts that you're kind of zeroing in on at this point? And how do you contextualize the gains that we've seen in these equity markets?
That's right. So I think it's obviously a bit of a quiet day today. I'm pretty sure I saw some tumbleweed go past the bonds desk earlier. But we've obviously seen those gains in European stocks that you mentioned there, and I think that was mostly driven by the decline in bond yields. So European stocks now on track for a 6th week of gains, and I just think that's a little bit over-optimistic, really, considering we've got some events that you mentioned there. We've got some big inflation numbers coming out of the Eurozone next week, and also Powell speaking as well. So we could see some risk coming in when traders come back from the US after the long weekend.
No tumbleweed on this set, please, Joe. Okay, so maybe a little bit, European equity investors getting a little bit ahead of themselves. Is it a different picture in the US as the Fed starts to kind of calibrate its response, 50 basis points, markets pricing in for December? How much of that is being priced into US equities?
I don't think there's enough of that being priced in. I was speaking to an investor just Wednesday, actually, and they were talking about how the damage that the Fed will do in terms of the central bank tightening haven't actually been seen yet by companies, haven't been seen in earnings. That won't come through until the next quarter's earnings at least, and into next year as well. We might not see the bottom of the economy coming in until the back end of next year. So I think for me, the impact of the Fed hikes hasn't been reflected in the S&P 500 for sure.
And China has been a catalyst for equity markets in the last few weeks. Okay, you strip out the last few days when the news out of Beijing and China more broadly has been terrible in terms of the rate of COVID and the restrictions. You take that out of the mix, And that was another ballast point for these markets a few weeks ago. That appears to have crumbled now because it's obvious that it's very difficult for them to move out of COVID zero.
Exactly, and the policy is so volatile. I mean, it can change every day. We're seeing different headlines coming out of China. We don't know which way it's going to go. We don't know how travel will be impacted in China. We don't know what the luxury demand will be. And the mining sector as well has been up and down, very volatile, given it's so dependent on China's economy. So there's too much there for us to be uncertain about to push equities higher, in my opinion.
Iron ore whipsaws on an almost daily basis. It's up today, presumably on expectations there's going to be more stimulus because they're under so much pressure within that economy. Fixed income, we've had a number of guests come on this week and say that is where you want to be positioned in 2023. And JP Morgan coming out and saying there's going to be $1 trillion of demand next year and that yields are going to come off. How do you think about that as you play into and look ahead to next year?
I think that the JP Morgan note's really interesting about the yields coming lower again, but then I think that it's so dependent on central banks, not just the Fed, but also the Bank of England. We've spoken about before, the UK central bank tends to have a very outsized impact on the bond market, and I do think that the central banker there, Andrew Bailey, is very cautious on the inflation outlook, and I think he could potentially surprise on a hawkish side, and therefore that could be negative for bonds. So I think there's a lot of risk in the bond market as well.
Okay, still a lot of risk in the bond market. Got to switch focus to football, Joe. You're our resident football expert. Ronaldo notching another place in footballing history after, of course, that dramatic move away from Manchester United. Just give us the update on what you're seeing. And, of course, England-USA, we need an estimate from you. We need a call on what the scoreline's going to be.
Yeah, I think very optimistic for England tonight against the USA. I think, Saka's flying. He looks like he could be a star. Based on the
That's
last
because
game.
he's at Arsenal, which is the best club in the world.
Well, I'd probably go for Mason Mount if it was me being a Chelsea fan. But
wait, what's the scoreline? USA-England?
Oh, 3-0 England, I think.
3-0 England?
3-0 England.
That's bullish. The Americans are hungry. This is a hungry team.
Got Pulisic as well. He's looking strong as well. Chelsea player, but I'm optimistic.
Ronaldo, does he have some more job offers, do you think, on the back of
Ronaldo, yeah. I think they're looking for him down at Burnley, I think. Or maybe Aston Villa, and that will keep Alex Webb happy.
Yeah, that would make sense. Burnley, yeah. Okay, all right, Joe Easton, thank you very much. Looking ahead to what may be driving these markets, and of course, what is going to be a thumping of England, by England, of England, by England. You know what I mean. 3-0, England versus USA. Thank you very much, Joe Easton. That is it for the European Market Open Surveillance Early Edition. Up next with me, bad luck. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then they trade you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
Power, policy, politics. politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Here's what's coming up on today's programme. Energy impasse, EU efforts to strike deals on price caps for gas and Russian crude stall as divisions push approval of some measures into mid-December. Oil trades little changed. COVID alarm, China's daily case count tops 30,000. That's for the first time, with parts of Beijing seeing panic buying as officials struggle to contain outbreaks across the nation. And Black Friday gloom, retailers brace for muted shopping results, while thousands of Amazon warehouse workers across 40 countries plan protests over pay and working conditions. Let's check in on these markets then. It is a little bit muted. There is a bit of lack of direction. Of course, traders coming back to their desks in the US for a partial day of trading. You have got money moving in to US Treasuries. You're seeing that across the curve, yields down. Across these equity markets then, you're seeing losses in European stocks around 0.2%. The context is you've seen a grind higher since around the middle of August, so 6 weeks of gains, but taking some profit, at least on the margins of European stocks today, down 0.2%. S&P futures looking to hold above that 4,000 level, gaining at 0.2% when the markets reopen in the US after Thanksgiving. The Bloomberg Dollar Index, the dollar is currently unchanged. You've had 3 days of weakness as it helped fuel that modest rally that we've seen in stocks, and we'll work out whether or not that is likely to continue. We'll be talking FX just in the next couple of minutes. Given what we heard from the FOMC, minutes and a step down maybe to 50 basis points in December. US 2-year currently at 4.44. That's a move lower by 3 basis points. As I said, money is moving into US Treasuries, even as it moves out of gilts and bunds. Here's your map then as we shape up this Friday, 1 hour into the trading session. In terms of your sectors, by the way, at the top of the list is energy, just eking out gains of 0.2%. Utilities range bound. At the bottom of the list is real estate, down 2%, I should say. So across the regions, you're looking at just the UK that's holding into gains, the FTSE 100, just 0.1%, but you're seeing losses of 0.2 over in Germany, the DAX at 14,500, and the CAC going 6,700, just a drop there of 0.1%. Again, these markets appearing to look for catalysts after the importance of those FOMC minutes. We're going to have more data out, of course, next week, which will round out the picture. Let's get to what is happening in the FX world, because the dollar has been so important to the trends that have been shaping up across these markets this year. We're joined now by Elsa Linhos, who's the global head of FX strategy at RBC Capital Markets. Elsa, thank you for joining us this morning. Happy Friday. Thanks for coming to the studio. Has the dollar turned?
A lot of people are ready to call it, particularly in Europe. So I've just been traveling around North America, and very striking how much more bearish European investors are on the US dollar. Personally, I think it's too soon to call it. Strategists are always itching to call turns, but typically they call 5 out of every 2 turns. So we're a little bit more cautious and waiting to see more meaningful direction lower in inflation before looking for the dollar turn.
So it's the inflation, it's those CPI prints that you need to see meaningfully lower. Is it kind of below 7%? Is it the rate, the level, or the rate of decrease in terms of those CPI prints that are going to be informative for you when it comes to whether or not the dollar has peaked? Currently down about 4% over the last month.
Yeah, so I think there's a widespread expectation, and reasonably so, that inflation will come down. The question is to what level? Because once we work through the commodity price base effects, and we can see it in the goods side of the equation that inflation is coming down materially, what happens with services? What happens with underlying inflation? And that's the key question for 2023.
Euro dollar, so many crosswinds for the euro. I just wonder if you can shine some clarity on the direction for the single currency. It's currently at 104. You have the energy story, you have the inflation, you have a recession recession. According to some of the economists we've been speaking to, possibly slightly softer recession than maybe some had expected earlier on in the year. The cross currents, what is the most potent mover of euro-dollar in the months ahead as we look in towards the end of the year and into 2023?
So what's really interesting about the euro at the moment is that it lacks a lot of independent direction of its own. For a lot of people, it's just the anti-dollar. If you're bearish dollars, you might be long euro dollar, but you're not necessarily long euros. It's just the flip side of your bearish dollar position. I think, though, one key thing to watch is how US equities are going to perform in relative terms. And we've seen it happen at times, but not really materially take place. If US equities were to underperform in size, then you could see a lot more money being pulled out by European investors back into European markets, and hence some euro-dollar buying.
That's really interesting. I haven't heard that analysis before. So watch for US equities when it comes to your views on euro-dollar. Let's bring it to the UK then. And the pound has rallied this week. It's currently at 121, I believe. 120, 121 on GBP. 121, yeah, it's down a little under 0.1% in the session today, but it was a strong rally yesterday. Not all of that was down to dollar weakness. Have we seen a turnaround for the pound? Can it hold at these levels?
So unfortunately, and I say unfortunately because we're both obviously here in the UK, when you look at the longer term outlook for the UK, it's incredibly challenging. A lot of the deficits, the imbalances that have persisted are only set to get worse. We're relying on the kindness of foreigners to fund the current account position. The budget deficit is not going to materially improve until after the next election, if that. So weak pound does have to be the escape valve to suck in that foreign capital.
Okay, and what levels are you looking at for the pound? Again, is it the 120 level? Do they go below that? What are you looking at in terms of the next level to hold for the pound?
So cable is actually a lot more about the US dollar than anything else. Euro sterling is the one that I'd be focused on. I think actually Euro sterling has room to the top side next year. So I'd look for it to trade sustainably above 90. And that could be where you see those equity flows playing out in the European space.
Okay,
Euro sterling.
Euro sterling above 90. Okay, we'll watch for that. Do you have a view on the Hong Kong dollar? Is this a red herring? Bill Ackman, obviously a big player. We all love it when someone like Bill Ackman tweets and he's got a short position on Hong Kong dollar. Is it a storm in a teacup?
We've seen a lot of movement in the vol curve in Hong Kong. It certainly feels like a storm in a teacup. Again, a little bit like strategists calling turns in the US dollar. A lot of people have called a break in the Hong Kong peg. Eventually, one day, it may break, but there's a lot of firepower to defend it.
Well, the other question is whether or not the yield curve control is going to break in Japan. Really interesting to see the inflation data out of Tokyo at levels last seen in 1982. Yes, Japan actually has inflation. Does that challenge the BOJ, or do we wait post Kurida or the governor when he steps down eventually in April of next year? Is it the next governor who's going to be consequential in terms of whether yield curve control continues?
So I think the Bank of Japan are far more likely to step away from yield curve control when the market is not pressuring them. Question is what that then means for the yen, because I think widespread expectation is the yen would rally hard on the back of that. I'd be a lot more skeptical. I actually think it'd be a great opportunity to sell yen on that knee-jerk reaction. And the reason being, the front end is not going to do anything. And as long as the Fed maintains rates up near these levels and Japan is stuck near zero, that dynamic is not going to change for dollar yen. Okay, it's of course Governor Kuroda. I was combining Kishida and Kuroda for that aiming there. When it comes to commodity currencies, Brent off, you're looking at maybe at three weeks now of losses. How are you thinking about commodity currencies? China is a key factor in all of this. Do you want to be short commodity currencies until you get more clarity on China? So I actually think in the commodity space, we've seen some years of structural underinvestment and a very tight physical market at the moment. So yes, the initial optimism around the China reopening trade has certainly waned, and with good reason. That's not to say commodity currencies are a sure bet lower. And in fact, I think there are lots of opportunities to play commodity currencies into 2023, particularly if you think about the likes of New Zealand or Canada against, say, Sweden.
Okay, New Zealand, Canada versus Sweden. When it comes to Asia, what is the most important? Is it the yuan that's the most important currency to watch within that region? Is it the movements around yuan, or is it the linkages with the US dollar?
So the linkages with the dollar have weakened over time. Critical, of course, what the China reopening story is going to be. I know it's obviously softened in the last few weeks, but there is a widespread expectation that in Q1 of next year, that reopening trade will resume again. And so that, I think, is going to send a far greater signal for the rest of the Asia complex. The problem, of course, at the moment is you don't have the yield that's on offer in some other regions of the world. Compare it to Latin America, the yield on offer in Brazil, in Mexico, and so on. It's just a very different outlook for the Asian currencies.
Any other crosses you would recommend at this point?
So we are actually looking at our 2023 trades, and I don't want to give it all away too soon. But certainly, I think there's opportunities to be short yen. We like long Swiss on the other side of it.
Okay, long Swiss, short yen. You haven't given it all away. You've given us enough, though. We'll get you back on next year to unpack all of that. Thank you very much indeed, Elsa Linios, of course, Global Head of FX Strategy at RBC Capital Markets. Right, coming up, the EU remains split over how to tackle the energy crisis with plans to cap gas prices and Russian oil exports put on hold. We're going to have all the details next. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Now, the EU has paused efforts to approve an energy package that would cap the price of European gas and Russian oil exports. Deep divisions remain over the plan to address the energy crisis. Spain has been a harsh critic of the plan, but one of its ministers remains optimistic that a deal can eventually be reached.
There was something that was missing, this very important signal to the markets and traders. Of course, we need gas, but we cannot be sold at any price. So it was important to provide some inputs on how we can send this signal to the traders. And for the time being, the proposal of the Commission was not sufficiently effective. I would like to see this dynamic solution.
Okay, for more on this, let's bring in Bloomberg's Maria Tadea, who's at the EU Council building in Brussels. Maria, it was all about the price caps yesterday. Still no agreement on either a cap for European gas prices. Not such a big surprise there, but nothing also on the cap around Russian oil exports. So what happened?
Yes, Tom, and it's all caps and yet no caps. And you make a good point to make a distinction between the gas and the oil because they are running parallel, but these are two separate discussions. Now, when you look into the gas cap, essentially the issue here is the threshold for it to be triggered is a 275 euros megawatt hour for 2 weeks that the countries that want to see a price cap do not like. They say de facto this isn't one. It won't bring down prices, and at this stage, it's fundamentally the opposite of what they wanted to see with the price cap. When you look at the Russian oil situation, it's slightly different, but nonetheless, the sticking point, again, is the threshold, is the price. We're talking about $65 a barrel, potentially 70, but for some of the more hawkish countries on Russia, like the Poles, but also the Baltics, they say that at $65 a barrel, that is way too generous, and Russia still, they want to see that come down, and that's essentially where talks are now a deadlock. Having said that, we're being told that today talks will continue. Potentially, we do get this breakthrough. When it comes to the gas, however, we're going to have to wait for a few weeks until December 13th. That is when energy ministers will reconvene again, and I will be on this exact same spot, potentially talking about the same thing.
Okay, two different parts of the energy mix, of course. So we're looking potentially then, you'll be monitoring this for us, of course, a breakthrough when it comes to oil. Gas, not until the middle of December, and you're going to be back on the ground for us. I think this is potentially a friction point that could become more tense maybe in the months ahead, and I'm keen to get your views on this, which is the division, at least the tension around and between the US and Europe when it comes to energy, and particularly that Inflation Reduction Act. How is all of that playing out?
Yes, and Tom, it's a good question, but also the two are extremely connected, and you can see why there's a thread that really connects the energy with the trade. And in fact, yesterday we had the energy ministers here in Brussels, and today we have the trade ministers. The concern for many here is that if you put together the energy prices, then you couple that with China, their aggressive industrial policy. On top of that, you get the Biden administration with the Inflation Reduction Act, which of course could be a real incentive for some of the green companies to move from Europe to the United States. They worry that the space they have to compete and stay attractive is becoming smaller and smaller. I spoke to the Czech trade minister. He said that pretty much every member state of the EU has a problem with the Inflation Reduction Act, but he also said we should not escalate with the United States. They are a partner in many ways, and we want to avoid a trade war. So it is a difficult balance here to thread.
Yeah, and no doubt they'll have memories of how their solar industry was crushed by the solar panel industry in China as well, and that will no doubt be in the back of minds. All right, Bloomberg's Maria Tadeo in Brussels, following all the twists and turns, and we may possibly get a breakthrough on oil. We'll see later today. Maria will be on the ground for us. Now, China's daily COVID infections broke through 30,000 for the first time ever as Beijing struggles to contain growing outbreaks. The rapid spread of the virus has led officials to impose new restrictions across some of China's most important cities. For more, let's bring in Bloomberg's managing editor for Greater China, John Liu, who's on the ground in Beijing for us. John, COVID-19 then continuing to spread in the capital, more broadly across major cities in China, and so too the number of restrictions. Where is this all going?
Well, it's looking like it's going to be a rather challenging winter for China. The problem is that the government wants to both ease back a little bit on the COVID curbs to try and limit the impact on the economy, which has been severe. But at the same time, as they've rolled some of those controls back, it's contributed to what we've seen has been record levels of infections around China here in Beijing. There were 1,800 infections announced for Thursday. It's the most the city has had throughout the pandemic. It is pretty widespread throughout the city. Every district is reporting cases, and we have limitations based on where people can go. Schools are closed, businesses are closed, and people are not traveling. They're not going out and buying or shopping. And so you can already see the sort of disruption like none that we've seen before.
Yeah, I was speaking to a contact on the ground there who's seen 4 of his staff taken off to central quarantine just in the last couple of days. John, in terms of food delivery services, so much enmeshed within everyday people's lives in China, is there a pressure point there? Are they overwhelmed, or are they able to get food into people's homes?
So it's been a bit of a sort of a contradiction. Food delivery apps have come to sort of a halt because the amount of demand has far outstripped their ability to fill those orders. So it's sort of a capacity constraint when it comes to couriers. At the same time, we've had several reporters go out and visit local grocery stores, and they remain fully stocked, relatively empty. One explanation might be that people, as you said, they don't want to get sent to central quarantine, and so they are avoiding going out as much as possible, risking potentially being identified as a close contact or even potentially becoming infected with COVID.
And John, this is the trillion-dollar question, really, for the global economy. Is there any sign after this 20-point plan that the Beijing is willing to kind of give up on COVID zero? What is your sense?
At this point, there is no indication that China is going to be moving away from zero as an objective. I think there are several ways to define zero. The clearest, I think, now is trying to get community spread to zero. So being okay with infections being detected in people who are in quarantine, close contacts, but trying to take the number of infections in the community circulating to zero. And as long as China wants to and aims to do that, the disruptions, I think, are unavoidable. That being said, I think in the longer term, after this winter, I think the country definitely wants to get out of this sort of terrible cycle of lockdown, unlock, lockdown again. How quickly it can actually do that, I think, is the big question. I think the answer as of now is it's going to take a rather long time.
It's going to take a while, and of course that is consequential for the global economy. Bloomberg's John Liu in Beijing with all the latest around those rising infections, what it means for those delivery companies, but also the outlook in terms of wrestling away from COVID zero. Thank you. Coming up, Black Friday in focus, of course. We're going to dig into retail and consumer spending on what is one of the busiest shopping days of the year. Stay with us. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
Stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. A redhead breaking across the terminal around the Indian conglomerate Adani Enterprises, looking to raise $2.5 billion US. That is about 200 billion rupees via a further public offering of shares. The share price, as you can see, taking a knock on the back of that announcement, is down 1.3%. So that's the redhead. Adani Enterprises looking to raise up to $2.5 billion with a new share sale. Right, let's get the Bloomberg First Word News now with Alice Atkins. Alice.
Hi, Tom. Ukraine says it's managed to restore about half of its power capacity, knocked out by attacks from Russia, with water supply also back in Kyiv. In the US, President Biden says he's confident there will be support in the newly elected Congress for additional aid to Ukraine. This as President Putin's war reaches the 9-month mark. Nurses in the UK are to strike on 2 days next month in a historic walkout over pay. The Royal College of Nursing is demanding a 17% increase, which the government says is not affordable. It's the first ever national strike by nurses. Malaysia's new Prime Minister, Anwar Ibrahim, will test lawmakers' support for his leadership with a confidence vote on December 19th to prove he commands a parliamentary majority. Anwar was sworn in by the Malaysian king on Thursday night, cobbling together a unity government with the Barisan Nasional coalition. The monarch intervened after no alliance secured a majority in the election last weekend. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom?
Alice Atkins, thank you. Let's briefly check in the markets then, about an hour and 25 minutes into the trading day. You're seeing losses across the European benchmark of 0.2%, but European equities are up, though. They've rallied since the depths of around August the 17th and the highest level since August the 17th, I should say. Futures in the US pointing to gains of about 0.1%. As you can see, traders getting back to their desks for half a day of trading after the Thanksgiving holiday. The Bloomberg Dollar Index currently up 0.1% after 3 days of losses. And the US 2-year just to move there lower by close to 2 basis points, 4.46 on the 2-year. Coming up, we're going to be joined by Dean Forbes, CEO of Forterra. Stay with us. This is Bloomberg.
digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
But look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues.
We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority. A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed. Welcome back. Happy Friday. Your top stories today. Energy impasse. EU efforts to strike deals on price caps for gas and Russian crude stall as divisions push approval of some measures into mid-December. Oil trades little changed. COVID alarm. China's daily case count tops 30,000 for the first time, with parts of Beijing seeing panic buying as officials struggle to contain outbreaks across the nation. And Black Friday gloom. Retailers brace for muted shopping results, while thousands of Amazon warehouse workers across 40 countries plan protests over pay and working conditions. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. I just want to update you on the oil story then, because in fact what you're seeing when it comes to Brent and WTI are pretty solid gains within the oil space. So we'll update that headline for you next time. $86 a barrel on Brent. That's again a 1.2%, almost 2% gain for WTI. Just below $80 a barrel, $79 per barrel for WTI. Right, let's get back to another story around the SMEs software. Really important in the context of what's happening with the global economy, but also what's happening within the tech space. My next guest was named the most influential black man in Britain in this year's Power List, beating none other than Marcus Rashford and Stormzy and Idris Elba. Homeless twice as a teenager, he's now CEO of the tech unicorn Forterro, which provides software solutions to more than 11,000 small and mid-sized manufacturing companies, not just in the UK, but across Europe. He also advises the private equity firm Corton Capital on its technology acquisitions. There's a lot to talk about with Forterro CEO Dean Forbes. Welcome to Bloomberg. Thanks for coming on set. Brilliant. Given the scope of your business, I don't want to start by getting a kind of a gauge of what you're hearing from clients. More than 11,000 SMEs across Europe. We talk every day about recession risks. You have your finger on the pulse when it comes to all of these clients. What are they saying to you? What is your sense of caution, trepidation? Is there concern, is there fear amongst your clients, or are they using this as an opportunity?
I wouldn't describe it as fear, Tom. What we've certainly seen is a number of clients are a little more cautious. They're taking a bit longer around CapEx and OpEx investments, but we're still seeing customers make good investment decisions. They're spending on technology because it is an opportunity to further automate and digitize the workforce and the business processes, and there are savings in that, right? There's opportunity for optimization in that. So yeah, not fear, but there's certainly an element of caution.
Because you've moved to a subscription model for the software business.
Right.
How is that process going? And are you seeing any clients, even if there isn't fear, are you seeing clients walking back their subs? Are they pushing back in terms of pricing? Is there any reluctance in that kind of area as you look to expand the business?
Well, certainly cash flow is king, right? The debt markets are out of control. The cost of debt is significantly higher than it was a year ago, and I think that's where the caution comes from. But moving customers to a subscription model or into the cloud actually takes away an element of investment and cost that they shift from their own balance sheet, into OpEx. So that again is an opportunity for them to conserve a little bit of cash, de-risk the business, and push some of that responsibility for IT onto suppliers like us.
And you're still adding clients in this environment?
Oh, absolutely. Over the last year, we grew 11%. Not as much of that came from net new logo wins as we would have liked. It comes back to that caution element, but we are adding new clients. We're seeing existing customers expand just a little bit slower than they had done perhaps 24 months ago.
Do you see that trend continuing into 2023?
Yeah, I absolutely expect it to continue into 2023. I don't think we'll be through the worst of the recession by then. I don't think inflation would have changed materially by then. So we do see that caution and slightly slower pace continuing into 2023. But again, it's caution, it's rhythm, it's cadence. It's not fear. It's not people coming to abrupt halts.
And you've had long experience within the tech sector. We talked about the fact that you're an advisor on a PE or VC firm. So you have deep knowledge of this. When you look at the layoffs across tech, a lot of it's happening, of course, in social media. You're seeing that with the likes of Meta, Twitter, but also in terms of payments, Stripe, for example. How much more bloodletting do you think there is? How far does this go in terms of layoffs across the tech sector?
Well, I think it's, first important to realize that most of these layoffs at scale are happening in the supers, right? They're happening in the Metas, they're happening in the Facebooks, they're happening in Twitter. And to a degree, it's just kind of right-sizing, right? Let's look at Twitter. It's a huge company, huge revenue, but hasn't made a profit in all of its existence. So to a degree, this is an element of right-sizing. Now, the difficulty for software companies like us is that then flows down into our organizations, right? Those people who are looking for jobs, you know, with higher salary expectations, they come into our market and they cause an element of compression among software companies like us. But we've seen this time and time again. We saw it in the dot-com, we saw it in 2008, and this is just part of the technology cycle that we go through.
Are you maintaining headcount? Are you adding? Are you cutting?
We're growing headcount next year. We expect to grow headcount, you know, in the mid-teens. That will depend to a degree on how the markets behave, how our customers behave. But our outlook is still pretty good and pretty promising.
Okay, and you talked about that 11% growth in terms of client add-ons. You're looking ahead to 2023. You think those trends are going to kind of stay? In terms of market share, it's a competitive space. You've obviously done very well. But as you look at expanding that market share, what is the target over the next 12 to 24 months?
Conservative. So our market grows between 8 and 9%. So growing above that is you know, normally something that we would see as pretty good. We expect to grow at 11 to 12% next year. So very slightly ahead of the market. That isn't consistent across our space. We see some of our competitors shrinking and kind of battening back a little bit. So, you know, we'll have to see. Our outlook is moderate, cautious, and we'll see how it goes.
Are you pursuing, is it organic growth that's the focus? You're a deal maker. Are you looking at organic growth, or are you looking at acquisitions? Are valuations looking attractive to you? And how much dry powder are you putting aside?
Well, debt is, of course, a problem. As I mentioned, it's kind of 40% more expensive, but we're a good cash-generative business, so we will be looking at M&A. We've been hugely acquisitive in the past. I think a shift in the complexion of M&A is, you know, great assets are less likely to come to market now, right? Investors will be patient if their business is good, still generating cash, and probably ride this wave out. So what we'll see come to market, and the opportunities that are probably going to be in front of us are for slightly lower quality assets where there's less cash in those businesses or reason to be concerned. It's that tone that will force people into doing deals in a market like this. So we just have to be careful at what we look to acquire.
That's really interesting. So still acquisitive, but you're saying the quality of those deals, the quality of those offerings may be a little lower than they were previously. In terms of your rapid expansion in that region, what other regions? Are you looking at the US? How big an opportunity is that for you, or Asia?
No, for us, we're super focused on the European space. So we'll continue to be acquisitive and look for growth in the European markets.
And within that sector, I mean, who are you supplying? Is it the industrials? Where is that demand coming from, particularly as these companies adjust and try and digitize? How much of a lag is there with these legacy companies? The SMEs that you're focused on, there's a lot of catch-up in terms of digitizing their businesses.
Absolutely, and that's what provides the opportunity for us. And another thing that provides that opportunity in a market like ours, supporting industrial companies and manufacturers, is a lot of them are looking to kind of bring manufacturing and elements of the supply chain back onshore, right? So previously they've depended on international partners for elements of the supply chain. They're looking to bring that, you know, back into the home geography. So that again provides an opportunity to, you know, digitize and bring software to deliver value across that chain as it comes back.
So the onshoring of supply chains is a catalyst for a business like yours. You're based here in the UK. To what extent has UK PLC been damaged by the politics of the last 6 months, or arguably the politics of the last decade? How do you see it? When you travel overseas, you meet with your clients, does that weigh?
Well, we've seen the impact of our political situation on the markets, right, on the value of the pound. And when you travel internationally, especially into the EU, you have the kind of recent political landscape to deal with clients and suppliers. And you also have our situation relative to the EU to deal with those clients and suppliers as well. So it's made, you know, trading, it's made doing business just that little bit more difficult. You layer on top a recession and inflation, and it hasn't been a great situation in which to continue to try to grow your business.
Okay, Dean, thank you very much indeed. Really fascinating insights. Dean Forbes, CEO of Forterro there, a business that has at least over 11,000 SMEs across Europe, on the opportunities there for growth in this challenging environment more broadly for technology. Thank you. Right, coming up, McKinsey & Co partner Anita Balchandani on Black Friday. We'll dig into the differing retail trends. We're going to talk about inventories. We're going to talk about just how much appetite there is for consumers to go out there and spend in this cost of living crisis with inflation, and just what the deals are on these markets. That is Anita Balchandani coming up next. Stay with us. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then destroy you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom Mackenzie in London. Black Friday, it is here. One of the busiest days of the year for online shopping. Shoppers in the UK are likely to see disruption to their deliveries, though, as postage workers from Royal Mail go on strike. Amazon staff, meanwhile, are planning protests and strikes in over 40 countries over paying conditions as inflation takes its grim toll. We are joined now by Anita Balchandani, senior partner at McKinsey and retail sector expert. Anita, always great to talk to you when we've got a big retail story on our hands, and of course Black Friday is one of them. What are the changing trends that you're seeing in terms of retail, in terms of consumer demand this year versus previous years?
Tom, this is a Black Friday like no other, right? Consumer sentiment is at a record low. For example, in the UK, it's below what we saw during the 2008 financial crisis and at the height of COVID. And we do expect overall Christmas shopping to be muted, with 3 in 5 consumers saying they're going to shop less. That said, consumer intention to participate in Black Friday is really showing a step up. 70% of customers expect to be shopping today. That's 10 percentage points higher than last year. And it's particularly high amongst the younger consumers. But I think it is important to say that this increase in participation is also balanced by a much more value-conscious consumer that's going to be hitting Black Friday today. So the big step up that we see is consumers that actually are looking for spontaneous deals and wanting to lock them in. In fact, one of the reasons we've seen this year Christmas shopping being pulled forward, you could also argue that Christmas came before Halloween this year, and that's because the deals started earlier, but consumers have also been looking for deals, particularly to lock in prices and to secure the best prices with the anticipation of inflation. So I think it's all to play for, frankly, for Black Friday.
Okay, so there's the demographics, maybe there's a more savvy consumer there as well, challenging these retailers. Is there a sense, Anita, are people trading down? Are they buying less? Are they doing a bit of both?
We do see some polarization in behavior here. So on the one hand, you very clearly have a flight to value and down trading. At the other end, you do see a flight to quality as well. And you see some of the luxury categories have been, relatively speaking, more resilient. So I think we're seeing that continued polarization or bifurcation in retail that's been going on for a decade. You see that, if anything, accelerated. But I think this Black Friday, we certainly will be looking at a more value-conscious consumer who's going to be checking out the deals and who's, going to be voting in a way off the back of the value for money that they receive. So they can kind of really maximize the enjoyment of Christmas while still sort of, being conscious of tightened budgets.
And Anita, so that's the consumer. In terms of the retailer, what are we seeing in terms of the ability to pass on costs and preserve margins, or are they in a rush to kind of offset and unload built-up merchandise and inventories?
Look, retailers are really sort of, managing the situation tightly and doing a combination of things. Many, as we know, have embarked on productivity measures, etc., to mitigate against inflation impacts. That said, the inflation headwinds are so substantial that price rises are inevitable. What we have seen this year is a step up in the level of promotional activity. So if you look at the fashion category, for instance, in October, 40% of the assortment typically was already on discount. What we also see is the days before an item goes from full price to discount is typically sort of gone down from, roughly 100 days to around 70. And we're also seeing sort of retailers looking to sell through earlier. Okay. So we also saw more of Christmas came earlier and even starting in October.
Anita, we just have to briefly jump in, and then I'll come back to this conversation. There's a red head on the Bloomberg terminal for our viewers, and this has been anticipated. This is the authorities in Beijing cutting that reserve requirement for the banking sector. So the China PBOC there, the central bank, of course, cutting the bank's reserve requirement ratio by 0.25%. You're looking at the yuan there, currently down just about 0.2% versus US dollar. Yes, this has been flagged, but this is just a reminder that, yes, the PBOC and the finance minister, this is the PBOC, of course, in terms of the action, but both arms of that government looking to support this economy now continually under pressure as a result of COVID-19. We're looking at record cases. The PBOC also vowing, and this is a line on the terminal, to step up implementation of prudent monetary policy. The PBOC cutting the RRR, it says, to release about 500 billion yuan in terms of long-term funds. So clearly keen to get that funding into the banking system and from the banking system into the beleaguered real economy that is China. Let's get back to the retail sector then. That is the redhead when it comes to China. We had expected it, but nonetheless, it is significant that they are stepping up support for this economy. When it comes to the retail sector then, Anita, and you were talking about the changes in terms of price cuts and discounting, what about the strength of luxury? The luxury sector has held its head up high this year. Year to date, it's done very well indeed. There has been the deep-pocketed consumer that's been coming to the rescue of that sector. Does that continue, or is luxury looking fragile in this environment?
Look, so far you're exactly right. The luxury sector has been, relatively speaking, more resilient. And in Europe also benefited from travel, and particularly travel in from North America, Middle East, etc. That said, I think if you look at some of the barometers or the signals, we're certainly seeing that the level of promotional intensity in luxury this year is starting to step up. We do think even within luxury, you have lots of different tiers of luxury. You have ultra luxury right up to accessible luxury. And I think we're seeing that right at the very top end of luxury, much more resilience in demand. But as you sort of go through some of the other sort of tiers of luxury as you will, we do see some signs that, of promotion and discounting activity and the need to activate demand in those segments.
Okay, Anita Balchandani, Senior Partner at McKinsey, thank you for doing a deep dive in terms of the trends, the shifting trends from the retailer to the consumer on this Black Friday holiday. Thank you. Let's get the Bloomberg Business Flash now with Alice Atkins. Alice.
Hi, Tom. UK power company SSE has agreed to sell a 25% stake in its electricity transmission grid business to the Ontario Teachers' Pension Plan Board for about £1.5 billion. The network helps transport energy from the north of Scotland to demand centres further south. The move comes after SSE rejected a proposal from activist investor Elliott to split the company in two by separating its renewables business. Elon Musk says Twitter will vastly expand the reinstatement of banned users from next week. That's after more than 70% of participants voted in favour of a general amnesty for suspended accounts in a poll organised by the company's new owner. Meanwhile, Twitter has now lost its final 2 employees in the regulatory hub of Brussels, just as it faces increasing scrutiny from EU lawmakers. 6 people were previously employed in the office. The account of the latest ECB meeting shows some officials wanted a smaller 50 basis point rate hike in October to combat record inflation. Those favouring a less aggressive move pointed to other measures that came with the hike, including adjusting the terms of cheap financing for banks. However, ECB Executive Board member Isabel Schnabel warned in a speech in London it may be too soon to scale back rate hikes. That's your Bloomberg Business Flash. Tom?
Alice, thank you very much indeed. Just recapping the redhead that crossed the terminal. Yes, the PBOC, the People's Bank of China, upping its support for that economy with a cut to the RRR for the banking sector, the reserve requirement ratio being cut by 0.25%. We had expected this, but it is a significant move. They often do it on Fridays, and it's a reminder of the need for officials in Beijing to step up to support this economy. And as if to emphasize what is happening in terms of COVID, another headline crossing, Nanjing, a city in southeastern China, a city, by the way, of 8.5 million people. They're going to be testing the whole city for 5 days from November the 26th in terms of the COVID outbreak there. And this RRR cut is going to kick in early December. That is the redhead across the terminal in terms of the PBOC, the support for that economy. Right, coming up, round 1 of the World Cup has finished. Every nation has played. We're going to have the key takeaways. It is England-USA, 7 p.m. UK time later today. Stay with us. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business. Business Authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Welcome back. Economics, finance, politics, and a bit of sport. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Yes, the first week of the World Cup in Qatar is coming to a close. We've seen Saudi Arabia topple Argentina, Germany stunned by Japan, and the favourites, Brazil, have yet to miss the tournament, won yesterday with a spectacular overhead kick. Simone Foxman has more from Doha.
12 years of preparations, 12 years of investments for Qatar, and it's been put to the test this week at the World Cup. Overall, at least from an infrastructure perspective, Qatar has met this test. People have been using the metro to get to and from the stadiums. They've been flying in and out without much fanfare from the international airport, and the country's overall been able to manage hundreds of thousands more people here in this very small area than normal. That said, the event has not gone off without controversy, especially over rainbows, whether it be rainbow-colored armbands or fans trying to get into stadiums and unable to after wearing rainbow-colored attire. That's something we're going to be looking for, whether it be between the teams themselves and pushing back against FIFA, or whether it be those fans trying to get access to the stadiums today, especially with the game between Iran and Wales, because those Welsh fans, they wear rainbow-colored hats. Also, we're going to be looking to see if we see any more stunning upsets, the likes of Saudi Arabia, Argentina, or Japan, Germany, as we move ahead into the second match for all these teams as they try to get through the group stage onto the elimination rounds. And then the question mark continues. Do we see the focus grow more on the field, or do we see it stay around issues that are off the field as teams start to get closer to leaving this competition? In Doha, Simone Foxman, Bloomberg News.
Bloomberg Simone Foxman there with the latest on the World Cup on and off the pitch. The markets, European equities down 0.2%, futures in the US range bound. It is England versus USA later today. I'm entirely neutral. Come on, England. Surveillance Early Edition continues in the next hour with Anne Edwards in London. This is Bloomberg.
Is the chance of humankind to really understand itself. How much of that is true? How confident? Did you actually overachieve? Did you, back then realize that we would be using AI in many different jobs? Was it slower or faster than you thought at the time?
I think if I had a 35 or 40 year prediction task, I would have been more or less on track as to where we are today. But I would have predicted steady linear increase over time. But instead, the field had very minimal improvements until the last 5 or 10 years. Then it really took off. I think we ended up in the right place, but I was very wrong about the trajectory. To this date, we still know very little about how the brain works, but these machines are getting ever more powerful. And I feel in some sense, we did end up learning what human intelligence is by learning what it is not. If we exclude all the things machines can do better than us as what makes us unique in our human intelligence, then now we can rule out many, many things, because AI or machine learning has become so good at so many things that what's left must be the key aspects of human intelligence.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Keeping unity in this situation is paramount. We cannot let Russia divide us on energy.
The proposal that's on the table now regarding the market mechanism is flawed. There is a lot of risk for damaging the energy security of supply and also for the stability of the financial market.
This is no time to walk away from Ukraine. Not at all.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kayleigh Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Europe split over a price cap on Russian oil. Some EU members warn against being soft on Moscow, while others are concerned the limit will be too tough. A record-breaking day in China. For the first time, the number of daily COVID cases goes over 30,000. Meanwhile, the PBOC is cutting banks' required reserve ratio to bolster the economy. And why Black Friday could be bleak. Inflation and sagging consumer sentiment may keep shoppers from spending the way they normally do. We'll get the US and global perspective. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London. Matt Miller and Kayleigh Lines are off today. Let us quickly check on the markets then. Let's get straight to the market action. And this is what we have for you from European equity markets, which of course are up and trading, and we're trading all the way through yesterday. We look forward to being rejoined with US equity markets later on today, just for half a day of trading stateside, but still there will be US presence. European stocks are down by 0.2%. The UK market goes up 0.1%. You can see the energy sector is gaining, and that is playing to the strengths of London, of course. So energy stocks up by 0.6%. We see that yields are going a little bit, yields are on the move today across Europe, going up a little across Europe. They have been decreasing, though, of late. That's been the general direction through November. So I just put in a couple of the bond markets, sovereign debt markets here in Germany and in France to give a sense of the most recent movement. Let's get through the FX markets, though, because there I want to linger a moment, as we've had news out of China, which isn't actually moving the FX market all that much, but it has been well flagged. So the dollar in general terms is stronger this morning, up around 0.25%, obviously dealing with the ebb and flow of Fed commentary over recent days and weeks. Then we have in here the offshore Chinese yuan. You can see there's not a great deal of movement, trades at 7.17. There'd been a lot of talk during the China session overnight in Europe about whether the PBOC would have to do more to support the Chinese economy. COVID cases climbing there, and we have heard in just the last 20 minutes that the PBOC is taking action. More detail on that in a moment. We've got an energy focus for you as well today. So Brent crude is up by 1.6%. Generally, the direction of travel in recent weeks has been downward, and we've been tracking the twists and turns of what the European leadership have been doing around energy prices broadly, gas and oil. We'll get to that conversation in a moment. Back to China, though. Tom McKenzie, Bloomberg's Tom McKenzie, joins me here on set in London to take us through all of the latest. Tom, very good morning to you. So let's start with the PBOC's response coming just 20 minutes ago.
Yeah, so this was flagged by China's State Council, essentially their cabinet, earlier in the week, and the cut to the reserve ratio is 0.25%. It brings that down to 11%. The reality is it pumps about $70 billion US, the equivalent of about $70 billion US into this economy that we know is struggling. Earlier this week, Nomura, for example, cut their forecast for 2023 growth out of China to 4%. Now, other measures have been taken, of course. Chinese officials are stepping up their measures to try and support this economy. For example, a package of measures around the property sector. We know the pain there has been acute, but also outlining this 20-point plan around trying to ease away from COVID zero. And we're seeing the complexities of that. So yes, it's been flagged, it's important, it's another step in the direction in terms of pumping liquidity into this economy. Whether it gets the real economy, from the banks to the real economy, when they're shutting down large parts of this country, it is another question.
Yeah, it's going to be really interesting to watch in the days and weeks ahead as we see COVID numbers climb in China. What is the market's reaction function to that? Yes. Because in recent weeks, there's been an expectation of loosening up, of change in policy, of a policy pivot from the Chinese authorities, and that had led to optimism about Chinese growth. When we're faced with higher and higher COVID numbers, how will the market deal with that? And that's what we've got this morning in the terms of the Chinese data.
Yeah, absolutely. And what you're pointing to is arguably unfortunate timing in terms of the policy response, bad timing. It would be another way to look at it. They did come out with this plan, and then they were hit at the same time as the plan with these rising COVID cases. So it just points to the complexities of removing and getting away from COVID zero. So you're saying, absolutely, top line, record cases in China. And it hasn't been announced, but there is essentially a lockdown across major parts of Beijing. I've been in contact with people there on the ground. One employer saying that 4 of his team members have been taken off to central quarantine. He was showing me photos of what is happening in central quarantine in grim conditions. There's a lot of anger on the ground in cities like Beijing. Another city, Chongqing, there's a population of almost 30 million people. Again, not officially in lockdown, but in all but name, it is. Again, a population bigger than the population of Australia. It is remarkable. Nanjing, this is a line that crossed a couple of minutes ago, population 8.5 million. They're going to test every single member of that city, 8.5 million people, over 5 days. So the real struggle is there around trying to move away from COVID zero. They have the plan in place. They're not able to restrict it or implement it because of these caseloads.
And I had a lot of conversations with our colleagues in Beijing earlier about just how quickly you can lift the COVID restrictions and the healthcare system still cope. And we've seen in some locations emergency healthcare provision having to be put in place to try and cope with the numbers that are anticipated. Tom, thank you very much for joining us. Tom McKenzie with the latest on what's happening in China, the COVID cases and indeed the economic policy response. Now let's get to the European stories around energy. Germany's Olaf Scholz doesn't want to start a new transatlantic trade war, and he's worried Emmanuel Macron may be stoking one. EU-US relations at the center of the trade minister meeting that takes place today.
Supportive measures like Inflation Reduction Act, there is definitely a threat that some of the European production can be moved from the profitability and subsidy point of views, more favorable markets. US is aware about our concerns.
Maria Tadeo joins us, our colleague outside the EU at the EU Council building in Brussels. Maria, let me ask you about what's going on with trade then. We just heard from the trade minister, one of the trade ministers in attendance. I set out a divergent set of views between Germany and France. This is a growing tension over the Atlantic, though, to do with what the Americans are doing on policy.
It is, Anna, because in some ways there is a real anxiety in Europe about the state of the European industry, how to protect it, but also potentially the real damage, the long-term damage that the war could inflict in some of the big industries in Europe. For a lot of the European ministers that we spoke to this morning, they feel, they believe they have been hit essentially by a perfect storm. You have the high energy prices, you have China with now an aggressive industrial policy, and on top of that, the United States coming in with this Inflation Reduction Act, which they fear, worry, perhaps is going to entice companies to move away, to relocate from the European Union to the United States because it's better for business over there. And now a lot of, critics will say what you see now in Europe is a result of bad foreign policy, bad energy policy that played out for decades. But nonetheless, that is a tension point in this meeting. And of course, it's also a difficult one to thread because these ministers will also tell you they do not want to trigger trade tensions with the United States in the context of the war in Ukraine because they are allies too on that front.
Yeah, absolutely. So we'll watch how that develops, how US domestic policy setting might forge some sort of European response or create concern in Europe. Now, it was all about price caps yesterday, but we still have no agreement on either a cap for European gas prices or a cap on Russian oil exports. What's been happening?
All caps, Anna, all day talk around caps, but in the end, we have no cap on either front. And again, just to remind our international audience, right now here in Brussels, you have two debates on caps. You have the gas cap, and then you have the oil cap, the Russian oil cap. And essentially, they're different, they run parallel, but the sticking point is very similar, is the price point, is the threshold. Of course, for Europeans on the gas, that threshold of 275 euro megawatt hour for 2 weeks in order for that cap to be triggered does not satisfy countries that want to see that threshold move and become a dynamic price point. And when you look at the oil, you have some of the more hawkish voices on Russia, like the Poles, the Baltics, who say at $65 a barrel, that is not going to punish Russia. But Anna, overall, what I would argue, however, is there's also critics that suggest this whole thing is noise. Caps are not really going to change anything. And if anything, we could see severe disruptions on the supply chain at a point in which the energy market is very tight, but also very fierce.
Poland clearly very close geographically to some of the fighting, to the fighting that's been taking place in Ukraine, and certainly has felt the effect of the huge refugee flows we've seen coming through from Ukraine. They're also very reliant on energy coming from the east. So what's Poland been saying in terms of this debate?
Well, Anna, the Polish, and this we really need to understand, they have a very complicated history with the Russians, the Russian Federation. Of course, we had that incident that happened last week where really feel the West was now standing very close to the brink. Remember the missile, the counter air defense Ukrainian that fell on the Polish side. But at the same time, they have been very outspoken in the idea that they stand with Ukraine, that Ukraine has to win the war. There's a lot of geopolitical tensions that they feel play out, and if Ukraine does not win the war, could reflect then for other Eastern European countries. And when it comes to migration, especially in the context of this terrible humanitarian situation that is going on in Ukraine with no electricity, no water, no heating, they are expecting more refugees to come in the winter. The temperature's already getting very cold in Ukraine.
Absolutely. We all watch the weather. Thanks very much, Maria Tadeo, joining us there in Brussels with the latest on what has been and what has not been achieved when it comes to agreement. They did agree on some of the other gas measures to do with joint purchase, but not on that cap, as she says. Now, from CZ to Cathy Wood, here's what a few of the key voices have been saying to Bloomberg this week, what they've been saying about FTX contagion.
I actually reflect on the FTX situation, and I kind of blame myself for tweeting that too late.
A cryptocurrency exchange has to provide for its users is to not lose their funds.
Right now, we have, it seems, from FTX, $5 to $10 billion in creditors as FTX has filed bankruptcy. They will be making claims.
The only real surprise is that the big funds that invested in FTX, that their due diligence was that poor that they didn't realize this was going on. It's absolutely outrageous.
FTX leveraged their novel and native token FTT to boost their assets, and likely as collateral to access loans. And with that money, they created sort of a really quick scaling in both their size and in their power and perceived authority.
As an industry, we let FTX got too big.
Joining us now, Bloomberg senior crypto editor Anna Herrera. Anna, one of the people we heard there was CZ. He was talking to us yesterday, of course, and we analysed a lot what he had to say about the FTX story. He also talked about the fund that Binance wants to set up. How has that gone down with markets? Has there been any reassurance through the conversations about creating that fund?
Not really. I think people are still a bit worried about contagion, and so saying we have a $1 billion fund is probably not going to cut it for them until we see if more shoes are going to drop, especially because we've had the U.S. holiday. So I think people, and a lot of the action has been in the U.S., so maybe people are saying, let's wait and see once like the week starts again if we'll have more contagion, and then perhaps we'll calm down or not, or we'll start investing again.
But. Yeah, and a lot of the focus seems to be on just how much of the money in the fund comes from Binance themselves and how much they can drum up support from others in the system. Let me ask you about those in this space who are trying to raise money at this point. It must be a really difficult time. I know you've been looking at Matrixport, which is a crypto lender, and it's seeking $1.5 billion. I mean, how easy is that going to be, or difficult will that be in this environment?
I think that's the valuation that they're trying to reach. They're trying to reach at a higher valuation than before. Of course, we had like astronomical valuations during the bull market, and now people are trying to shore up their investments. That's what we're being told, that they're trying to save the companies they've invested in, and it's really not a great market. VC investments have fallen in crypto, so especially if you're a new startup, this is probably not a great time. So we'll see if they're actually able to raise at that valuation again.
Okay, that was the aim. Let's see what they actually managed to end up with. Anna, thank you very much. Bloomberg's Anna Herrera with the latest details on the twists and turns in crypto this week. Coming up on the programme, we'll talk macro with Freya Beamish, TS Lombard chief economist. What does she make of the policy support or lack of it against energy prices in Europe? What difference will that make to the European economy? We had growth data out of Germany earlier. We'll also talk about China, and we will have a discussion about the strength of the consumer this Black Friday. Lisa Hooker joins us, consumer markets leader at PwC. We will have a US and global conversation around retail, plus how Apple's reliance on China is growing perilous. Read more about the chaos in iPhone City in today's Big Take story. Look for that online or on the Bloomberg terminal. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I do think that it makes sense on our side to be a little bit on the slower side compared to what we have done in the past.
Mandatory is price stability. So as long as inflation is well above 5%, we may need to continue.
Doing so requires raising interest rates further for as long as needed to put inflation back on a sustainable path towards 2%.
Although my bias is towards further tightening.
We will need to be mindful. Adjusting too little will leave inflation too high, and adjusting too much could lead to an unnecessarily painful downturn.
Because then we can see what happens in the economy as a whole, and to what extent what we have done really sort of takes hold.
If the economy develops differently to my expectation and persistence in inflation stops being a concern, then I'd consider the case for reducing bank rate as appropriate.
Central bank officials offering diverging views on the future path of rate hikes. It's been a busy week for central bank conversation, even as it's been Thanksgiving week. Let's get to a chart which is of interest and a conversation about it. This is to do with emerging markets and the softer dollar overlaid over EM debt yields. And this is interesting because, of course, the dollar is very influential on how difficult emerging markets find it to service their debt. And we can see interesting movements in tandem on this chart. Let's get to Dana El-Bartaji, who joins us, Bloomberg Managing Editor for Credit, who can give some insight into what's going on with emerging markets at the moment then. Dana, really nice to have you on the program. So we've seen some of these yields coming down just in recent sessions, and BlackRock has turned more positive on emerging market debt. Is this just a dollar call? How much appetite are we seeing for EM debt?
There's a lot of appetite for EM debt, and that's mostly because we've had an absolutely horrendous year for risk. We've seen yields shoot up so high to levels that we haven't seen in many, many, many years. And what we've seen now is because there is a softening of the rhetoric among monetary policies worldwide, we are starting to see people say, you know what, maybe it is time to go into more risky assets. Now with EM in particular, what you have is this index, which is headed for its best month since, I think it's May 2020. And even then, that month was extraordinary. This is actually, if you exclude that massive drop in COVID, right? If you exclude that, this is actually the best month since 2009.
Okay, so it goes in conjunction, goes hand in hand with the appetite for risk assets that we've seen in recent weeks.
Oh, yeah.
But all this comes a little too late for some emerging markets, and Ghana is just today's example of emerging market that is struggling. A haircut being proposed there on debt holders.
This is absolutely it. You can't look at emerging markets as one big blob, really. There are so many little stories in there, and we've got a lot of pain points, and Ghana is definitely one of them. The original sin that basically led to a massive blowout in U.S. debt among emerging markets is basically now showing that there is a lot of pain there, and Ghana is one of them. They are looking into the possibility of a 30% haircut and the possibility of not paying some of those interest payments, which is a massive hit for people, because when you buy Ghana debt, you're buying it for those interest payments.
Yes, and so we'll see whether this the turn in the dollar that is much talked about at the moment, but not everybody believes in it, whether we've seen the peak dollar, whether that stands, because that has a big bearing, of course, on these emerging markets. Back here in Europe then, Daniel, let's talk about that. European corporate debt markets looking a little bit less distressed, yields coming in. I mean, this is all part of the same dynamic, isn't it? An increased appetite for risk.
That's absolutely it, and especially that index that we're looking at the safer names within Europe.
So investment grade.
Investment grade. And a lot of these bonds, they blew out not because the credit itself wasn't good, but it was because appetite for bonds wasn't there. And that's because we've been seeing rates going up. So naturally, you would sell off bonds. Now these names are looking very attractive again, and people are coming back in, rightly or wrongly, because we don't know if inflation really is slowing or if it's going to rise again. As you mentioned in your last segment, the issue with China and whether or not it's going to close down because of COVID again, that's the major factor here.
That's having a big impact globally then on all kinds of asset markets. Thank you so much, Dana El-Bartaji, joining us there with the latest on credit markets. For more market analysis across various asset classes, you can check out MLIV Go. That's the function to use on your Bloomberg terminal to find the Markets Live blog. This is Bloomberg.
Decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight, with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London. Keeping up to date with news from around the world, here's the first word. In Ukraine, half of the capital's residents are still without power following a barrage of Russian missiles. The mayor of Kiev warns that limits on electricity will continue. President Volodymyr Zelensky says the situation with power is difficult across the whole country. In the UK, nurses plan to stage their first ever nationwide strike for 2 days next month. It's an historic sign of defiance in a dispute over pay. The British government has said that calls for pay hikes 5% above inflation are not affordable. A new report predicts the world economy will be as weak next year as it was in 2009 after the financial crisis. The study comes from the Institute of International Finance. It forecasts that global growth will slow to 1.2% in 2023. That's largely because the conflict in Ukraine risks becoming a, quote, forever war. And thousands of Amazon warehouse workers in about 40 countries will mark the Black Friday sales day with protests and walkouts. They're demanding better wages and working conditions in a campaign called Make Amazon Pay. Employees in the United States, UK, India, Japan and Australia are among those taking part. Amazon says it will take, or it takes, its role seriously on what it calls these important matters. We'll get analysis of Black Friday, the US experience, the global story shortly. We'll also talk to Freya Beamish, TS Lombard chief economist. How is she updating her view on China given the COVID threats and monetary policy response? This is Bloomberg.
in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close. Welcome to Bloomberg Crypto. Welcome back. This is Bloomberg Surveillance Early Edition. Here's what you need to know. Europe splits over a price cap on Russian oil. Some EU members warn against being soft on Moscow, while others are concerned the limit will be too tough. A record-breaking day in China. For the first time, the number of daily COVID cases goes over 30,000. Meanwhile, the PBOC is cutting banks' required reserve ratio to bolster lending in the economy. And why Black Friday could be bleak. Inflation and sagging consumer sentiment may keep shoppers from spending the way they normally do. I'm Anna Edwards in London. Matt Miller and Kaylee Lyons are both off today, so let's have a look at where we are on the markets that are open. We will have stateside trading, of course, a little bit later on today, but a half day for many assets. Certainly equity markets closed for half the day. So the equity market picture here in Europe is looking a little lonely right now, just fairly flat on the Stoxx 600. Energy names doing better, up by 0.9% for energy stocks as we see the Brent price at 86.69. A little bit of movement on debt markets. Obviously, the trend in recent sessions, or the trend through November, has been for some of these debt yields to be coming down. Let's have a look at the FX markets and commodity space as well, because there is something to say about what's going on in China, even if it isn't having much of an impact on the CNH. You can see the offshore yuan in there at 7.17, not moving. But the announcement from China, from the PBOC, that it was cutting the bank's reserve requirement ratio by 0.25%, 25 basis points. It was well flagged. It was expected, so perhaps it was all priced in. And it is designed, of course, to stimulate the economy, an economy that is increasingly facing challenges around COVID. Joining us now with analysis, Freya Beamish, Chief Economist at TS Lombard. And Freya, we'll start there. We'll start on China. We've seen the PBOC response today, cutting the RRR for just the second time this year, in fact, so trying to put that monetary policy stimulus into the economy, increase lending. What can that kind of policy do in the face of another policy which might be operating in the other direction, and that is around COVID?
Yeah, and you could add to that as well the kind of general lack of desire to borrow, which is a kind of a structural issue that is, when you put those two things that you just mentioned together, is exacerbated by the COVID shutdowns and the problems surrounding COVID. I think this is really a country that has a problem with liquidity. They don't know how to create liquidity in this environment without depreciating the renminbi more rapidly than they are willing to allow. And that's a problem in terms of what we expect for growth next year. The way you can kind of forecast growth in China very simply is just to take the change in short-term interest rates and lag that by 2 or 3 quarters, and then lag that tells you what's going to happen to money growth.
and then you lag that by a couple of quarters, and that tells you what's going to happen to nominal GDP growth. Right now, money growth is running at 5.8%. That's M1. That's very low by Chinese standards. We've seen a tiny bit of a pickup, but it's not going anywhere. Hence the reserve requirement ratio cut. And the second kind of channel for monetary policy at the moment, which is very underappreciated, is when they're issuing local government bonds, the special bonds. It's often the banks that are buying those, essentially kind of funded by the PBOC. So that's another way that the PBOC has been getting liquidity out into the economy. What we've seen now is that those quotas have been used up for this year. So this is a fresh drag that is coming into the economy in terms of the liquidity provision to the economy that's absolutely necessary for the turnaround. When we talk about the kind of the COVID side of it, there's two factors you have to bear in mind. The lack of ICU beds and the kind of the lack of vaccination for the old age population.
Yes.
Only 2/3
and both of those, Freya,
vaccinated.
And both of those bits of information, a lack of ICU beds and a lack of vaccination for elderly people and effective vaccinations, those things are going to limit the speed at which China can reopen, I suppose. And importantly, of course, in the very immediate months, we're dealing with winter.
Yeah, absolutely. So kind of two-thirds of the old age population haven't been vaccinated yet, or at least they've had less than 2 jabs, and you need 3 in the Chinese case to really feel more confident. And there are kind of less than 5 ICU beds per 100,000 of population, and that's very, very low. So it's not just a kind of a control thing. It's also they can't afford to take the risks that have been taken in other countries, in more developed countries, but because they don't have the infrastructure to be able to deal with the waves of Omicron that are coming. So that really kind of, when you put together those two things that you headlined, the liquidity problem and the problems with COVID, it really suggests that this kind of rally that has started on the hopes of faster opening up is somewhat kind of overboard.
Let me ask you about inflation and the dynamics we're dealing with in Europe then, Freya, because clearly supply chain issues, some of that starting with COVID, but long-lasting, long-living, and still being endured by some. But adding on to that, of course, the energy crisis, and we have very elevated levels of inflation in many markets. And Europe, we get the Eurozone print next week for CPI, and I see there is an expectation on the Bloomberg that does tick down slightly. Do we have any sense that we've peaked in terms of the inflation story in Europe? I mean, the Bloomberg currently tells me the prior reading was 10.7. We expect the one next week to come in at 10.4. That's not much of a step down, but it would be something.
So one of the big shocks that we saw coming through in the inflation pipeline in October was the energy companies kind of actually bringing that through to the high street, and that in a sense could have been anticipated. There's a lot going on. But particularly for countries like Italy, that was where we saw the massive spike up, and it was about energy. So yeah, we should have the sense that this type of digestion of these shocks into at least the non-core items has peaked. It's not necessarily the case that the digestion of those non-core items into core has peaked, because there is actually a lot of pass through into the actual what we term as core. But actually is very, very much driven in many senses by what's happening in commodity markets. And in terms of the supply chain problems, they should be easing, but now we have these refreshed problems in China, and I was slightly worried to see that manufacturing goods prices jumped up again month on month in October in China, and that could filter through unless it's a kind of a statistical blip. So we're looking at a slowdown in inflation, actually kind of at the margin, probably quickest in the US, although from a broader perspective, I have said that I think that's a kind of a mirage.
Yes, indeed. We've had that conversation. Thinking about the US, we're going to hear from Chair Jerome Powell next week. And what was interesting about the minutes was that other voices were amplified. We heard from other policymakers at the Fed, of course, and it seemed that there are more dovish takes around now, or at least than the market had anticipated. What risk then is there to the markets next week when we hear from Powell himself? I suppose there's a risk that he reignites that hawkishness.
I think so. I think we're coming now perhaps to the last hawkish surprise, but that surprise hasn't quite happened yet. So whether it's kind of 75 in December or or 50, it seems likely that Powell and those around him are going to want to try to keep financial conditions still tight. And if they go 50, then financial conditions can start to loosen again. And what we think the Fed is trying to achieve is this sort of like shock to the economy by actually getting real rates high enough to cause the recession. So it's not about inflation. I just said that I thought inflation was going to come down reasonably quickly. If you hold core goods prices flat and there's no input from transportation services into core, then you can get to 4% core annualized rates, three-month annualized rates by April. So that trajectory, we could bet that's where we're going. But the problem is that there's still some strength in the economy, and we're only just getting sort of anecdotal evidence at this stage that the labor market is starting to crack. What the Fed needs is 3 months of kind of weak employment, negative employment, before it's able to say, okay, well, we've done enough. And then when we see that happening, it's actually probably going to be the case that the Fed cuts more rapidly than people are expecting. So from where we're sitting, we're still more hawkish on the way up, but we're probably more dovish on the way back down again.
Freya, thanks so much for joining us. Freya Beamish of TS Lombard. Thanks for spending time with us here on Bloomberg TV. Coming up, we'll get to the retail story. We'll talk about Black Friday and the effect of inflation on the consumer. We'll be joined by Lisa Hooker, consumer markets leader at PwC. She'll give us the UK perspective. We'll talk about the global phenomenon that Black Friday has become. But we'll also be live on the ground in the United States, where apparently people might already be shopping. Let's see. Kriti Gupta is live for us. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
What we're seeing is a return back to the 2019 pre-pandemic buying pattern for the holiday. That's why we're really saying, what does that mean for Thanksgiving? What does that mean for Cyber Week? What does that mean for the last 10 days before Christmas? So we're adjusting our plans to accommodate anticipated higher peaks.
Lots of festive lighting in that shot. The CEO of Macy's sharing his outlook for the holiday shopping season. Joining us now from Herald Square in New York, just outside Macy's, I understand, is Bloomberg's Kriti Gupta. Good morning to you, Kriti. I mean, it's morning for me. It's very much morning for you. And very much morning for the people who've already gathered at the shops around you to not start shopping, but to show their intent. Let's talk about the health of the consumer then, Kriti. They might be looking forward to some shopping, but how healthy is the consumer in the US?
Well, Anna, we've got some committed shoppers right here outside of Macy's. Some people are still actually going with the long old tradition of lining up and waiting for a lot of those purchases. That being said, though, this is important in the context of a potential recession on the horizon. Remember, Anna, I'm a markets gal. 2023 is starting to forecasted by all indications to already see that recession, the inflationary pressures catching up with the consumer. But right now, they are still spending. In fact, spending is supposed to grow over 2.5% year over year. That tells you that people are still shopping, but they're not doing it with their stimulus checks in this country, which was really the kind of driver of a lot of the spending last year. Instead, Anna, credit debt is back. You are starting to see people spend on a leveraged basis now that they actually able to do so, really using some of that stimulus funds from last year to get rid of their mortgages, to get rid of their loans, and that frees up some of that credit card spend for shopping.
Okay, and retailers will, of course, be hoping that this Black Friday sends them into the black. Chrissy, how are retailers positioned for this one then? What have we been hearing already through the earnings story?
Well, today is a little bit of a litmus test for the entire holiday season. Remember, you do want the consumer to show up, and you want them to show up in force, because one of the issues right now that you've seen across the earnings story is simply that retail volume is actually low. The prices are high. It's that price hike that has actually been helping the likes of Walmart, for example, or even Macy's. Where it's really taking a hit is Target, it's Nordstrom, and that's going to be some of the issues right now. That divergence that you're starting to see between wealthier clientele versus the lower income consumer. Can they all come together and really help some of these retailers navigate the higher commodity pressures, the higher inflationary pressures that, once again, you are seeing around the world? And right now, the jury isn't out yet. So Black Friday is going to be a great test to see, are we going to start seeing more and more spending through the holiday season?
Okay, and what about, so that's the story around the retailers. This is going to be an important litmus test. What about inventory levels? Because that's been something that we have been hearing more and more about from these retailers. And for some of them, this is a really important opportunity to try and get some of that inventory out the door.
Higher and higher markdowns, Anna. That seems to be the key, and you're starting to see that actually become the trend. In fact, that's why this Black Friday is expected to actually surpass levels that you saw even pre-COVID, even in 2019. One of the big issues, though, is to what extent does that become the Achilles heel for the likes of Macy's, for example? If you have higher promotions to get rid of that inventory, are you still going to make up on the bottom line? Nevertheless, from a stock market perspective, if you get rid of those inventories, the market will reward you. So it depends. Do you want to see maybe better profits for your shareholders, or do you want to see a higher stock price? That seems to be the choice for a lot of these retailers at the moment.
Kriti, thank you very much. Find somewhere to stay warm. Bloomberg's Kriti Gupta, resisting temptation to go shopping herself and giving us the latest on the US retail scene this Black Friday. Let's get a more global perspective, and in fact, get a perspective from here in the UK. Lisa Hooker joins us, consumer markets leader at PwC. Lisa, nice to have you with us on set here in London. So let me go to the UK story, and you've been doing some research around just how much appetite there is for Black Friday, because, you know, this started out very much as a US phenomenon the day after Thanksgiving. It migrated across the Atlantic some 10 years or so ago, maybe more. Do Brits still go for this?
Well, actually, despite all the headwinds we've got at the moment, we're seeing that interest has held up this year on Black Friday. And we're expecting about 60% of people to actually shop. And of those, about 25 are saying we're definitely going to spend. And the expectation is we'll probably spend about $500 million more than we spent last year. Okay. So there's definitely good interest.
So there's still good interest. And you've done a survey. You've got some data to back this up, of course. So from that survey data, who are the people who are most interested? Is it sort of a younger dynamic, or how does it break down?
Yeah, it is very interesting. Men are more interested than women, and it's particularly around electricals and for themselves, while women also around electricals, but also for the family. And the under 35s are the most interested, with about nearly half saying we're going to shop. So they, again, are thinking about treating themselves. It's a leisure activity, but also everyone is slightly prepping for Christmas.
Yes, and I mean, a few years ago, pre-COVID, we used to see queues outside shops, long lines outside shops, and in some cases, people being injured, trying to get into shops. I mean, have we seen the end of that? Has this sort of opportunity to do this online if you want to, has that removed that, or should we brace ourselves for similar images?
I do think it's become an online shopping journey in terms of the UK. So you're not going to see the same level of queues or fighting. And also, it's not really over 2 days anymore, it's over a couple of weeks. Having said that, there's more people actually this year do want to go back into shops to do Black Friday, because I think people just want to get out there and have a bit of fun.
Yeah, let's say no to the fighting. That doesn't sound like a good idea.
No.
What about, I mean, there are bodies who do research around these deals, and it's certainly from a very UK perspective, sometimes they find that, you know, that it's not a great deal, actually, when you compare it to what the price was in the previous 12 months. I know Which does that kind of analysis. I mean, where are we on that kind of story? Is it really worth getting so excited about Black Friday?
I think some of these reports are quite harsh. No one ever says it's the best day of the year to buy. It's one of the promotions they do across the year. So we see them, you know, after Christmas, we see them in summer, and we see periodic promotions. So it is just a promotional tool, and the level of discount does generally vary depending on how much excess stock you think that you may have. And also, when you think about electricals go down in price over time anyway as the new range comes out. So it might not be the best offer across the whole year, but it is definitely a promotional period.
During COVID, of course, things were in short supply, and then we had a real inventory build across retail. Are we still, in the UK, are we still dealing with the unwind of that big ramp up in inventory, or have we worked that off? What's the sort of UK retail story?
It's actually really mixed across categories and retailers. So actually last year, because we couldn't get stock, there's some retailers that then stocked up before we really saw the hit of this cost of living crisis. And there were some who are a little bit more cautious. So it's not general. You probably see a correlation. Those who are discounting more are those that are carrying more of the excess stock.
And what about the strength of the UK consumer in the face of that cost of living crisis? You can't move for headlines around higher gas prices, for example. How much are we expecting that to limit people's enthusiasm for Black Friday and the holiday shopping season running up to Christmas?
I think actually one of the reasons people are interested in Black Friday is to plan for Christmas and also look for bargains to try and reduce the cost of Christmas. I do think it's going to pull forward sales from Christmas, and Christmas will be quite muted, and we're probably expecting that on things like festivities and presents there will be a reduction in the amount people will spend.
Of course, cost of living faces people who work in retail as well, and we've seen strike activity being talked about by various countries from Amazon workers. Is that something that we should brace for? Because I don't know whether the sector has been very unionised in the past or organised in a labour sense, but we're certainly seeing that from something like Amazon employees.
We are, and I think what that will do will repeat of what some of the things we saw last year, where people actually bought a bit earlier because they're worried about either the Royal Mail delivering the parcel or getting it from Amazon. So we haven't really seen this before, but I think it will encourage people to use Black Friday and be more prepared for Christmas.
Okay, thanks so much. Thank you very much for joining us, Lisa. Lisa Hooker joining us there from PwC to give us the UK retail perspective. Now, coming up, the first week of the World Cup has finished. We have some key takeaways from week one. That's coming up next. This is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up, what should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London. Now, the first week of the World Cup in Qatar is coming to a close. We've seen Saudi Arabia topple Argentina, Germany stunned by Japan, and the favourites Brazil win yesterday with a spectacular overhead kick. Perhaps they are still the favourites. Simone Foxman brought us more from Doha.
12 years of preparations, 12 years of investments for Qatar, and it's been put to the test this week at the World Cup. Overall, at least from an infrastructure perspective, Qatar has met this test. People have been using the metro to get to and from the stadiums. They've been flying in and out without much fanfare from the international airport, and the country's overall been able to manage hundreds of thousands more people here in this very small area than normal. That said, the event has not gone off without controversy, especially over rainbows, whether it be rainbow-colored armbands or fans trying to get into stadiums and unable to after wearing rainbow-colored attire. That's something we're going to be looking for, whether it be between the teams themselves and pushing back against FIFA, or whether it be those fans trying to get access to the stadiums today, especially with the game between Iran and Wales, because those Welsh fans, they wear rainbow-colored hats. Also, we're going to be looking to see if we see any more stunning upsets, the likes of Saudi Arabia, Argentina, or Japan, Germany, as we move ahead into the second match for all these teams as they try to get through the group stage onto the elimination rounds. And then the question mark continues. Do we see the focus grow more on the field, or do we see it stay around issues that are off the field as teams start to get closer to leaving this competition? In Doha, Simone Foxman, Bloomberg News.
Simone Foxman there in Qatar, and I was there 10 years ago, and there were no public subways at all. Incredible infrastructure achievement, but as she rightly points out, a lot of controversy off the pitch and some controversy in terms of the scorelines on the pitch as well. That is it for the show. Just time to give you a quick check of the markets, though. Let's have a look at where we are on the European equity session. Of course, our US friends will be back today. They'll be joining us on the football field later on in Qatar. But in terms of market action, we've got the Stocks Europe 600 up by 0.12% this morning. We've got energy stocks gaining up by 0.7%. Let's move on and show you what's going on FX, because we have seen the dollar, well, in fact, the Bloomberg dollar index is just up 0.1% or so today. The yen is actually quite weak, down by 0.6%. The euro is pretty flat against the US dollar. We've seen not much movement in the CNH, the offshore yuan. That's despite the fact that the Chinese Monetary Policy Authorities, the PBOC, they cut the RRR, the reserve requirement ratio for banks, so essentially meaning more money can get into the system, more loans can be made, and that should support the economy. The second time they've done that this year. The COVID challenges mount, of course, for the Chinese economy, and monetary policy authorities trying to do their bit to support the economy. Energy remains topical, along with trade over in Brussels. More from Maria Tadeo and the team on the ground in Brussels as we go through the day. That is it for Early Edition. Surveillance is ahead. This is Bloomberg.
successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
We're in the early stages of a sustainability revolution that has the magnitude of the industrial revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
We're expecting a mild recession, just slightly more likely than a soft landing.
We're pretty confident that the peak isn't too far off in the US, despite the fact that officials still sounding hawkish.
The Fed will likely, do 50 to 75 in December.
The Fed will be early to pause. We think the last Fed hike is in January.
What happens between now and next spring, that path is highly uncertain.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It's countdown to 2 p.m. Good morning. This is Bloomberg Surveillance on Bloomberg Television and Bloomberg Radio. Tom Keene, John Farrow, Lisa Abramowitz. Tom and John are both off coincidentally. It just happened to be on a day when England and the U.S. are playing in the World Cup. Go figure. With a coincidence, I am so glad Damian Sassower is joining us because, first of all, I cannot talk about the World Cup. If I do, people will start throwing things at the screen. But second of all, you always bring a host of knowledge on a day of a real reset heading into 2023. World Cup, you watching?
Richarlison, what a kick. Did you see that bicycle kick?
That was amazing.
Unbelievable.
The scissor kick, yeah. Okay, so I actually did watch this.
He's a tot. So, Tom Keene's got to be home right now, like, what's going to go on here?
You think it's an accident that he's off? All right. So we're also seeing the markets close at 2 p.m. And we are getting this sort of reset of where we go. The year is ending in 2 weeks. What's been the main theme that you've felt from all of the sort of outlook notes that you've been feeling?
Well, the narrative is shift back to the Fed pivot, right? I mean, everyone's calling for the Fed pivot again. I think the market is pretty much accustomed to the fact that Europe is definitely going to head into recession next year. The U.S. not so sure. And so for me, it's this Fed pivot. It's Leo Brainerd basically getting more dovish. It's Chair Powell holding on to his hawkish rhetoric. And the fact that we have PCE next week. We have payrolls next week. We get a lot of data coming through. We're going to see if the Fed can hold the line.
In the meantime, a lot of people were hoping that this optimism would be fueled by the sense that China would be reopening. Yeah. And overnight, I think this is actually incredibly important. I was reading about the shutdowns in Beijing, the sort of reinstated cases, and the case numbers that are surging to record highs. How much does that shape your view in a different way heading into next year based on all the optimism out of all of the shops around emerging markets, around global growth, around supply chains normalizing?
Well, for that economy to open up, it's going to take time. And I think it's more of a second half of 2023 story. And certainly everything that I'm reading over the weekend, everybody's come out with their outlooks. They're looking for China to kind of muddle through the first half, but then the second half, we see the rebound. Look, we're going to see fourth quarter GDP this year on something in the order of 3.94% in China. But it's that PBOC rate cut. I mean, look, we were expecting, 50 before the end of the year. They only delivered 25. So yes, while they're injecting liquidity, it's not going to be enough here to to basically offset the declining pyramid that's going on there in China property credit.
We're going to talk about that coming up with a host of incredible guests that we have on the show. We have former Fed economist Claudia Sahm. She's at 6:30. We have Christian Muller-Glissman of Goldman Sachs, an incredible voice, 7:45 a.m. Jordan Rochester of Nomura at 8 a.m. We also have Luke Kawa. We have so many great guests. Yeah, I know. He's going to come back on. We can't wait for that.
Get Luke back on.
Before we go through markets and the brief, which is going to be so brief, we're all looking for 2 p.m. when the markets close and the World Cup happens, where the U.S. versus England. What were the hottest topics at your Thanksgiving dinner?
Well, God, it had to be the fact that the Jets are going to Mike White at quarterback. I mean, I mean, look, the fact that they're benching Zach Wilson's a pretty big. No, I'm kidding. I think I think reality was, I think the turkey was a little dry. Maybe the stuffing was a little bit overcooked.
Okay.
I don't know if that had anything to do with the actual turkey itself or my cooking, but nevertheless, I think that was a lot of the conversation there. I do. I love turkey.
It's ridiculous. That was one of the conversations for us.
You don't like turkey, so Chinese food.
No, we actually had fish. But I mean, I do think that there is this feeling that, the do's, the don'ts. The turkey is sort of not the main course. It's the trimmings, and the turkey is dry. So you can kind of put it with whatever you see. I will say right now in markets, a very quiet tape. We're looking at an S&P that's basically meandering between gains and losses. S&P up about 0.1%. Nothing's happening. The euro dollar unchanged. You've got 10-year yields up just a fractional 3.7%. Amazing to see the round trip. They're down, I think, yields are like down 15 basis points or something on the week. And crude, marginally higher, although some of the outlook there, and we'll get into this later on, perhaps not as bright in terms of just the international demand. Joining us now is somebody who thought that it was going to be a gray day. Who thought, I might as well join them because it's going to be so gray here. And instead, he's sequestered in a corner because it's so bright in his room. Kit Jukes, Chief FX Strategist at Societe Generale. Thank you so much for being with us, Kit. You talk about that it's not a Black Friday so much as a gray one, not perhaps in your room, but generally. How so?
Well, it's a day when, I'm not sure there's that much optimism around in the global economy this morning, and I'm not sure that there's, much going on. But it is this sense of, even in the U.S., slowing economy across Europe. I mean, it's, how do you go running out on all these cheap prices to buy things when you're worried about energy costs, worried about mortgage payments, and so on. So, the global economy is clearly slowing, and that's the backdrop. The shocker, you mentioned it, but it's how much yields have fallen, how much the market has priced back Fed expectations since Jay Powell gave that press conference and told us that rates had to be higher for longer than the market was pricing just then. So we are just definitely giving the birth to a central bank collectively because we think the global economy is slowing.
Well, but Kit, this is really confusing, especially because in those meeting minutes, essentially Fed officials said that they expect recession as almost as likely as their base case. This is as close to capitulation from a central bank that, yes, there is going to be a downturn, and yes, we are going to keep rates high in order to curtail inflation, even if that does become the base case. Do you think that hasn't gotten enough attention?
I think it gets attention. I think here's the difficulty with this cycle, and it's probably true pretty much everywhere, is that in most major economies, we're going into a downturn at full employment. And, if the last big recession was this time is different, this is different all over again differently. I can't remember a time when you have full employment into slowdowns and probably through quite a long time. So the battle is between central bankers and how much they think they need to tighten and for how long to cool the labor market at the same time as they can see economies weakening significantly. Different sides of the Atlantic, you have a slightly different take on it. But I think that's the piece. The central bankers are looking at slower data and things, but they're looking at the labor market and thinking, how do I really get to grips with inflation without getting a higher unemployment rate?
Kit, it's a sleepy Friday here in November. And for me, it's not always been that way. If you think about the year-end turn, if you think about cross-currency basis swap spreads, they've really behaved rather well given all of the tightening and the liquidity pressure we would have expected to see into year-end. Are you surprised by any of this?
Well, they were behaving so badly 6 weeks ago that everyone got themselves into a state about them. And I think people started dealing with it very early. So we had a longer lead through. I still worry that they'll come back in the last week of December and ruin my life. But that's what we're paid to do, is to worry about things like that. But I think that what we made, that there's a possibility that, particularly in the foreign exchange market, that from the war in the Ukraine, the Fed hiking first, the energy crisis, the fact that the US benefits from terms of trade as the world's second biggest energy producer. Never had that before in an energy crisis in modern times. All my clients have ridden the dollar rally for months and months, and by and large, they let's close up the turn, let's shut everything down, let's quieten down and start getting ready for Christmas.
Well, Kit, we're also seeing tentative signs of investors re-engaging with non-dollar asset classes here as we approach year-end. So I'm just going to ask, the elephant in the room: has the dollar peaked?
It's peaking. I think it's, for want of a description, it's not a Matterhorn peak, but a Dolomites peak, if that works for Americans. But it's going to be a series of jagged peaks because, the other elephant in the room, the crisis in Ukraine, can, we're all downplaying the tail risk from that. It can come back in a flash. So we've got things we can get concerned about. Clearly, if things escalate and things get worse in China, that can make us worried. But yes, look, the dollar is going to be significantly weaker by the end of next year. We may see, I think there's a real chance that we may see the dollar quite a lot weaker by the end of this year and then stronger in January, just to blow up every Outlook piece that anybody wrote, just because positions come off.
Kit, I'm glad that you talk about positioning. And I've got to say, when I was reading your note, I felt like it was pretty gloomy. And I thought, okay, I wonder what your pushback is. I get accused of being gloomy all the time. How much do you buy into this argument that there's already so much gloom that there's no room to be gloomier, that stocks have to rally, that the dollar has to weaken just because people have already baked in all of the bear cases that could potentially happen?
I hear that from our equity people and our credit people. And for example, in the season of outlooks, if the first one I saw from anybody said, next year is the year of yield, which sounds pretty gloomy if all you're supposed to do is to buy bonds. The next, the view that we would have is that credit spreads look as if they're better able to cope with the kind of downturn we'll get than equities in some ways, but that the equity problem is maybe more in small companies than big ones, which small ones which can't cope with the volatility we've had in sort of events that affect them. But yeah, I think there's a lot of negativity for the way that this will play out priced in. I think in the foreign exchange market, part of it is, I view it slightly differently. When people start looking at a soft landing and they say, growth's going to slow, we're going to manage soft landings, that seems likely, the Fed's done soon. They sell the dollar because we get to the ideal point of the smile where the ECB's still raising rates, the Fed stopped, or it's all priced in, and so on. I still worry that the bigger problem could be later. We don't think we're really going to get a recession in the United States till 2024. The danger with this labor market and with the Fed hiking the way they've been is that if the labor market's so tight in going into a recession, the hammer that you need to break the nut of inflation might have to be hit really hard, and you may get later, harder landings rather than earlier, softer ones. But so it may well be that you get, equities do reasonably well in the first half of next year, and then we have to rethink it. But yeah, for now, everybody is believing that you can soft land the global economy despite this unique combination of zero unemployment at the beginning of a recession.
Kit Jukes,
of a landing.
Societe Generale, thank you so much for joining us, Kit. I hope you enjoy the beautiful sunshine outside, despite the gloom of what we're talking about. And I do think that it would be an incredible band name. What is it? That special place in a smile?
Yeah, that special smirk, the dollar smirk.
Yeah,
not
the dollar smirk.
It's not a smile, it's a smirk.
Have you ever seen less conviction in different year-ahead forecasts than you have this year?
Last year. No, I'm kidding. No, I know. I definitely agree with you.
Last year, the year before, and the year before. Let's see when they reach that. Right now, in markets, not a lot going on. It is the Friday after Thanksgiving. A lot of people are home watching the game. Wow, there's a little bit of euro weakness, a little bit of dollar strength. Not really, it's basically flat. Coming up, we've got Luke Hawa, Director of Investment Solutions at UBS Asset Management. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Retailers in the U.S. are bracing for a slower than normal Black Friday. High inflation and sagging consumer sentiment are hurting Americans' demand for material goods. According to S&P Global Market Intelligence, seasonal sales are likely to fall 1.2% after adjusting for inflation. That would be the first decline since 2009. In China, the central bank has taken another step to boost the economy. It's cut the amount of cash that banks must hold in reserve for the second time this year.
The adjustment to the reserve requirement ratio takes effect December 5th. It will inject $70 billion of liquidity into the Chinese economy. In Ukraine, half of the capital's residents are still without power following a barrage of Russian missiles. The mayor of Kyiv warns that limits on electricity will continue. President Volodymyr Zelensky says the situation with power is difficult across the whole country. In the UK, nurses plan to stage their first ever nationwide strike for 2 days next month. It's a historic sign of defiance in a dispute over pay. The British government has said that calls for pay hikes 5% above inflation are not affordable. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues.
We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
You can think about, 2022 as really being in an environment in which the second largest economy in the world, the largest commodity consumer in the world, was hibernating.
That was Jeff Curry, Global Head of Commodities Research at Goldman Sachs. And of course, he was talking about what we see in China when it comes back online. A big question. It looks like it's further away from that than closer. And we've been looking at the potential and what looks like the reality of Beijing, the main city of the mainland, being locked down with cases surging to record highs. Joining us now to really parse through what's going on is Bloomberg's Tom McKenzie. Tom, I am curious as we look at the situation in terms of the social response of one of the biggest cities in the world getting locked down after a time when the pandemic in other places is over.
Yeah, and for the context, Beijing, the capital, has never been locked down throughout this whole period. Now, the authorities are not saying it's locked down now, but that's essentially what's happening. Compound by compound, things are being closed down. I've been in contact with people on the ground this morning. They've been telling me there is visceral anger now in the lines, lining up for an hour plus to get these tests that people have to get on an almost daily basis to get into anywhere. Visceral anger on the ground. There's challenges around getting food into your home. The delivery apps are under pressure. So this is a concern, is a deep challenge for officials. They put out this plan a couple of weeks ago to kind of walk away from COVID-0. That has collided with the reality that they're now facing record levels of infection. And it isn't just in Beijing, capital city, 26 million population. It's also in a city like Chongqing, where they've got an effective lockdown as well. The population, by the way, there, 30 million, more than the size of Australia. This is in major cities around China. The closed loop system for manufacturers and producers is also being challenged. We're seeing that play out in Foxconn. So yes, how they respond, how officials respond to this emerging dynamic is going to be consequential. They wanted to move away from this. The reality on the ground is it's only getting worse.
So, Tom, how are they going to deal with this from the social perspective? Are you actually seeing the images go out on social media in a way that is new, that is different than the past 2 years, of a very different tone?
I was just checking my WeChat account and I posted or saw images. I wasn't posting. I saw images people had posted online. People have been taken away to these central quarantine centres where the conditions are appalling. Overflowing toilets, not enough beds, dirt on the floors. There is that anger, and it is being shared online. The authorities are going to respond, as they do always, with a rapid clampdown on the sharing of this kind of information. Those kind of images will not be up for long. There will be protests, continued protests. You can expect that. There'll be further unrest. Is it a real direct challenge to the authorities in Beijing? I think we're a long, long way from that. They have incredible control, particularly around the surveillance state that they've built up, the infrastructure in these major cities. It will be, though, deeply concerning. The number one priority is social stability. You're seeing that now starting to fray at the edges.
Yeah, Tom, you mentioned Chongqing. I look at Xinjiang. I mean, overnight we had a fire there, and 10 people passed away because, the firefighters were slow to react due to, obviously, the containment measures, right? And social media is up in arms about it in China. But I want to shift gears. I want to talk about the PBOC. I want to talk about the rate cut overnight. Obviously, widely anticipated. People were looking for it. Is it enough?
Is it enough? Probably not. If you listen to the economists out there, Nomura, for example, they've downgraded their forecasts for China's economy for next year to 4%, which in the context, of course, is relatively weak when you expect, and many people expect some of these measures to have eased by 2023. We'll see if that indeed happens. Will it be enough? No, probably not. So you had a triple R cut. This is the reserve ratios within the banking system, cut by about 0.25%. But it is building on these efforts by officials to try and put a floor under this economy. It's going to release about 70 billion into the banking system. A key question really is whether they can actually shift those funds to businesses at a time when so many parts of this economy are closed off. Can they actually get that funding into the real economy? That is going to be something to watch. It's the second time they've cut reserve ratios this year. They've cut the benchmark lending rate as well twice this year, and they've unveiled a package to try and support the beleaguered property sector, as well as this step-by-step plan to have a more targeted approach around COVID-0. We've just been talking about how badly that is going. So yeah, the challenges are there. They're trying to get more liquidity into the system. Whether or not the banks are prepared to to lend it out. Whether or not the businesses are prepared to take on that liquidity, I think is another question.
Tom, I mean, you hit the nail on the head there, right? It's about bank lending. It's about demand for housing, right? I mean, demand's fallen off a cliff also. I mean, talk to me about some of these measures and how it's going to impact China's property sector. We know the pain that's going on there. You know, demand from households for housing, banks' willingness to lend to property developers. Talk to us about that. Can we expect that to change in the months and year ahead?
Yeah, and for the context, the property sector makes up about 20% of China's GDP when you tie in all the linkages from the property sector, about 20% of GDP. So they've come out belatedly, many would argue, with this package of measures to support the property sector. They've done things like they've corralled the biggest lenders, the biggest banks, got them into one room with some of the major developers and said, look, work out some of your differences in terms of addressing some of these loans. They're going to be focused on the developers that they think ultimately can go through and survive. They still don't want excessive borrowing within the real estate sector. Their key concern with making sure that properties and developments get finished, that those people who put deposits down on houses get into those properties, and that doesn't trigger further social unrest. But in terms of the excesses around the bubble and the buildup of credit and liquidity within the real estate system, they want to see that avoided. It's a very, very difficult balance and very, very difficult and fine needle to thread. But most people do think this package of measures should be enough to at least put a floor under that property sector.
Tom McKenzie, thank you so much for all of the reporting throughout the day. I am curious, Damien, why are people so bullish on China if this is what we're looking at on the ground?
Well, I think what we've learned in the last few weeks is Chinese equities are up 25%, in the last month, really. I think what we've learned is that while, China, a lot of people aren't buying what China's selling. You just can't have zero exposure to China any longer, because when you have a low liquidity environment like this, it doesn't take a lot to move the needle, 25%. And if you miss that move as a fund manager, as an investor, it's something to be mindful of.
Okay, I get how this could be a short-term positioning type of reach as people look to the year end and try to salvage their performance. But when you look at the outlooks, that is one of the consensus calls that China will outperform next year as we look at this real tension around lockdowns and inability to move away in a constructive moment. I mean, honestly, it's hard to see how we get there. So what do you make of that?
Well, I think on a relative basis, if you look at the beta regime, which is one that's shifting from interest rate risk, inflation, to growth concerns, i.e. recession risk, I mean, you're not going to buy equities, at least U.S. equities, in that environment necessarily. So where you're going to get that beta exposure, you may have to turn to emerging markets, which are effectively China. Now, look, I agree with you. China has proven, in terms of their respect for property rights for investors.
I'm just saying,
I understand the right to be bearish, but again, from a diversified portfolio manager perspective, to ignore China and have zero exposure altogether is probably not the right move.
Well, and this is also one of the question marks around oil prices and how we deal with the lack of demand coming from China, right? So if you believe that China is going to come back online, you could see why some people have remained pretty bullish on oil. If you believe that the lockdowns and what we've seen in terms of demand falling off a cliff from China is truly the case, you get what we've seen, which is an incredible sell-off in oil prices. And so this, to me, is one of the pivotal underpinnings of everything that happens next year.
Well, absolutely. And Jeff Curie, I think Goldman Sachs is calling for $115 by the end of next year. Look, it's not about where prices go. Prices will go to $115. They can go to $140. It doesn't matter. It's where will they be sticky? Where will they stay? And what will the average price be over the next year? It's really about this transition in beta regimes and how quickly it happens.
Do people talk about inflation at the Thanksgiving table?
A little bit, yeah.
Yeah, do they talk about
It was an expensive
prices?
turkey this year.
Is that what they talked about?
A really expensive turkey this year.
Did they talk about the stuff?
I don't want to give you the number.
How expensive?
I can't tell you. It's embarrassing. It's embarrassing.
Really?
Yeah, I think we overpaid.
What kind of turkey?
We overpaid. It was a nice turkey. She was a love.
Yeah.
A beaut.
Okay, we'll talk about Damien's turkey later on, which she doesn't want to talk about. Coming up, Claudia Sahm, founder of Sahm Consulting and former Fed economist. This is Bloomberg.